Binance going down the way FTX went down. Like that's my only major concern. But these things kind of blow up when the price is dropping, not when the price is rising. Like when the price is rising, everything's okay. You can paper over a lot of your stuff. But my only big concern in Bitcoin and crypto space right now is Binance. Like I just don't see anything else that could, stop Bitcoin in its tracks.
Okay, yeah, Mario, I was always saying we're not at the end of the bear market throughout the years, but yeah, this is starting to feel like the next cycle, but there's obviously so many black swans that can happen.
I would be really careful about making big ass conclusions like this based off 2 days of price action. I would be very careful. I've been trading for a long time. I've traded everything. And typically when you have euphoria off of a rip like this, it ends badly for the people that call it a day. Bitcoin's rallied big, okay, but it's been 3 fucking days. I mean that it's you don't want to be making big statements like Bitcoin's never going below 20K again. 25 break. Set this in stone. Go back and look at the August-July rally last year in stocks and crypto. Everyone and their mother was like, "It's over. We're at a bottom. You buy everything." And then in August, you got stuffed and made new lows in 1 month. So, yeah,
no,
100%. I think everyone needs to take a deep breath and calm down.
My view is that
it's a small bounce in speculative risk on sentiment. That's all it is. It's a bounce in risk on sentiment. Bitcoin was a bigger beneficiary this time because the narrative fits it better this time. Yeah, a bank collapse. Yeah, I guess that's bullish for the Bitcoin narrative. But again, I'm not saying it can't go higher. I'm not saying we're going to go lower right away. But take a deep breath and just think about the time frame and think about how long this bounce has really been. A 3-day bounce is not going to change as many minds as you think it will. Has been, over the last few days trading outside of its relation to markets, sure. But generally, when people get into a sense of euphoria from a 3-day bounce, not only are they sorely disappointed, but they tend to lose money. So just be patient. I'm not saying this rally's over. I'm not saying it can't go a little bit further, but I would hesitate to be making big declarations like Bitcoin can't go below 20K again.
Yeah, stocks. Let me clarify that I'm a multi-decade Bitcoin investor. So when I'm talking about I accumulate every month no matter what the price is. So I prefer the price to go down. I prefer extended bear markets because it's the long-term fundamentals. But you're absolutely right. Bitcoin is incredibly, it's impossible to just look at the short term and try and make an assessment around that. And I've got a much longer time frame than that.
Yeah, and that's great. If you have a long time frame, that's fine. But I think, don't read too far into a 3-day bounce in anything, not just in Bitcoin, in any asset or any.
No, I took the words out of my mouth. I was literally about to ask you, wouldn't you say the same for just about anything, Bitcoin, small caps, whatever? You would. Yeah, exactly. I want Bitcoin to go up. I want all asset prices to go up over the long term here. So I don't know. I'm so glad you said that at the last minute there, Stock. Like 3 days, historical news being absorbed and reading into just about anything, thinking it's going to be, sustained over a long period of time is where sometimes people lose a lot of money.
Yeah, like the most true statement is that in the very short term, markets are a voting machine, and in the long term, they're a weighing machine. So, if there is, unspoken changes in the value or perception of value in Bitcoin as a result of this banking crisis, then maybe it will go high. But
I think something, and sometimes we have to say this. I'm going to make the assumption that most people in this room are buy and hold investors and probably go about investing passively and holding on to their SPY or ITOT or whatever broad-based index in the market. And you guys, if you're holding on and navigating volatility and that's your long-term approach, I think y'all have to pat yourselves on the back for, not letting human behavior derail your long-term investment strategy. And that could be around, Bitcoin, it could be around US equity indexes, it could be about whatever your strategy is. We get caught up in this so much, and something, I just can't help but to put out there for all of those listening who are being long-term and disciplined and holding. You're doing great. You don't have to, because we're talking about Bitcoin ripping, feel like this is the time you need to take a position in that because it's going to 30,000 plus. You don't even need to short, regional banks or buy the dip on them. You just need to be disciplined and stick to a strategy that works for you. And I think everybody needs to hear that from time to time, especially this morning as things start to look rosier.
If you look at the last rally back in February, you went from 21 to 25 in like 2 days. And then within 3 days, you were back in new lows. If you look at the September rally, you went from 18 to 24 in 5 days. Within 3 days, you were back in new lows. If you look at the July-August rally, in 4 days, you were up 6K in Bitcoin. Within 5 days after that, you were back in new lows. So the idea that we get excited about 3 or 4 days of price action is like, it's just misinformed.
Yeah, and specifically with Bitcoin.
Yeah, I think adding context is because I earn in dollars and I save in Bitcoin. So I want the price to go down because the more the price goes down, the more Bitcoin I get to buy with the dollars that I earn. And because I value my wealth in Bitcoin, I don't like bull markets because I get less Bitcoin for my long-term savings. But it's kind of the distress in the mining market that's probably making me have a bit more hopium than we should be expressing in front of 12,000 people, because it's quite an important factor for the recovery of many victims that have been effed over in some of this fraud that happened in the crypto market. So I'm quite looking forward to that. But it's really, really vital for you to put that disclaimer in.
I've asked the team to get us all the analysts we've had over the last year. They've been doing this for years, to come and give us their thoughts. Maybe I see Da Vinci's in the audience as well. Da Vinci, I know you're probably just woken up, but you're in Dubai. You should probably be awake now. It'd be great to have you come up for a few minutes, give us your thoughts. Have sent out a few more invites. Would be good to get more perspectives. Again, I just want to warn everyone, like, this is not any advice. I'm not buying any Bitcoin. I'm not selling any. I don't even trade. So this is different perspectives. Do not FOMO into anything in life. And generally speaking, trading, I'm not a big, Simon, we did a whole space on the concept of trading. We're not big proponents of trading, me and you, and research backs up the risks of trading. But like you just look at the fundamentals. I want to go back to the Binance concerns that you mentioned. Tone, you mentioned some we've talked about. We did a whole space on Binance and gone through all the concerns there. Obviously, it's a very big black swan event that could change things. So I want to dig into this in a bit. But Da Vinci, it's been a long time. We haven't had you here. How are you? Can you hear me, Da Vinci?
I'm doing well. I'm just driving right now in my car, headed to dinner.
Dinner? Oh, you're not in Dubai?
I'm in Dubai. I'm heading to eat something, actually. I'm just headed downtown Dubai.
Oh yeah, shit! It's 5 p.m. Okay, you've got a good sleeping pattern. I just woke up 2 hours ago, even though I'm in Dubai. David, I just want to get Da Vinci. I just want to get an idea of what your thoughts are on the market, and not only with the change we saw, the spike we saw in the last 2 days, but generally speaking, with all the FUD that we've seen over the last few months. Do you think we've seen the worst of the? We've seen the worst of the brunt, and assuming Binance is okay, or do you think there's more to come?
I think we're going to see something big in the financial sector, the regular financial sector with the banks and so forth. I think something big is coming in the next few days, maybe even as early as tomorrow, where we're going to see some massive fireworks, right? Because when Joe Biden came out, I mean, okay, that smells bad. But hopefully that.
You might just quickly, Da Vinci, we can just hear you. I don't know if you can. I know you're driving. Is there any chance your mic you can fix your mic in any way?
Okay, can you hear me now? How about now?
Yeah, it's better. Yeah, much better. Thanks a lot, man. Yeah, go ahead. Talking about Joe Biden's speech.
Yeah, Joe Biden came out and said the financial system is strong. That is the biggest indicator there's something very, very wrong. right? If you have to make that kind of confidence boost, that means that the underlying is worse than we know, and they need to have people calm down, the average Joe calm down so they can steal their money. So, so I would definitely get cash out of the bank if I were you for the next few days. And if in a couple weeks things go back to normal, then you can put it back in. I mean, it's not going to hurt you. But cash right now, even if the dollar collapses, cash would be a good thing to have because then you can buy pivot into assets, which would be marked a lot lower than when the hyperinflation comes. It seems weird that way, but what happens is because of our system, the way we are trapped in banks, right? Most people won't be able to buy anything or move anything during hyperinflation. And you're like, what? What are you talking about? That's not hyperinflation then. Well, you won't, but some other people, wealthy people, will be able to move money, and it's just not going to be you. so, and so that's going to move prices in the sense, and then they're gonna probably buy up all the real assets with their printed money, and you get nothing. So I think getting cash would be a good idea because you know what, they're also going to freeze your banks, right? So that you can't buy groceries. You can only buy a small amount, right? It's going to be like what, $400 a day or something like that you can actually spend. So yeah, so look out for that. If that happens in the next little while, oh my God, right? Because remember, all the banks are insolvent with the rates being raised, right? They can sell their good assets to the Federal Reserve, but not their bad ones. And now, technically, they got to change the rules, right? They can say, okay, well, you can sell your bad assets to the Federal Reserve, and they will print the money and give it to you at the face value. Now, who knows? They might do that. I don't know what they're going to do. Let's see what happens to shore this up. They're going to probably try to shore it up. And then if it does work, whatever they do, you've got like probably 6 months before the whole thing really, really collapses.
Hey, Da Vinci, thanks for joining. Hey, Mario, I gotta go. I gotta do a stream in 5 minutes. I just want to say real quick, look, obviously anything happened to me, and yes, it's just been 3 days. When you look at it in complete isolation, not caring about the asset, it's just a 3-day move. But for me, there is 3 things to try to analyze the price of Bitcoin. One is the charts. I'm a technical analyst. It's the chart. Second is the news cycle. What's going on in economics. It's the same thing that we do in a regular stock market. What's going on with these banks. And the third is on-chain analytics because Bitcoin blockchain is so publicly open that you can do analytics on what's going on under the hood with Bitcoin. Now, of the 3, that's my, for me, that TA is number 1. All 3 of these metrics completely lined up for me. I was waiting for the pullback to 20K and a strong bounce off of 20K. We've now moved past a very critical resistance of 25K. Yeah, if you look at it in isolation, that is just 3 days. Yeah, of course, the obvious view is anything can happen. But if that's your view that anything can happen, you should never make a trade in your life. At some point, you gotta have confidence that something is gonna happen. And if you're wrong, that's what stop losses are for. So for me, I am personally as confident as I've ever been, and I've been writing about Bitcoin analysis since 2014 publicly. And I am as confident as I've ever been that we're going up. That's my personal analysis. It's not trading advice. But I am personally confident, not because it's 3 days, but because of the way it went down, where we pulled back to, how we broke out of it, and everything that's happening in the world right now, and the distance to the halving and Bitcoin cycles, like everything lined up perfectly to bounce off 20K and break to new highs, and it just did.
All right, I want to go to Joe as well to get your thoughts. Joe, you helped us analyze you come on the show a few times to give us an analysis of the Bitcoin price since last year, and you've been doing this for a lot longer. Would love to get your thoughts. You heard what Da Vinci said, you've heard what Tone said, and Simon. Now, where do you stand on the movement? Mainly not the movement we saw in the last 2 days, because as Stock Talk said, that can be misleading, or usually is. But what we've seen over the last 6 months, the bloodbaths we saw a few months ago, the bloodbath we saw over the weekend, and where we stand today.
Yeah, absolutely. Thanks for having me on, Mario. Yeah, I mean, I think my thesis around Bitcoin from a long-term perspective remains unchanged. I think Bitcoin is the best money discovered. Perfectly scarce, it's portable, it's durable, it's divisible, it's fungible. And I think Bitcoin goes through these highly volatile adoption cycles, where we had one in 2013, 2017, and the most recent one in 2021. And then these adoption cycles are followed by massive, treacherous bear markets, exactly like you were talking about, where half the industry completely implodes. The weak hands that are holding Bitcoin are knocked out of the market. The over leveraged miners, the over leveraged traders are knocked out of the market. And we get to a point where the price is down 80 something percent. The only people still holding Bitcoin at that point are people that recognize that Bitcoin is the least uncertain money that we have. And they're adding more to it on a daily basis. And there's simply not many sellers left at low enough prices. And now we see the point where, okay, banks are starting to fail. The Fed is coming in and bailing out depositors. A record high percentage of Bitcoin has not moved in over a year. I think the stage is set for Bitcoin to do very well over the next 2 to 3 years.
And can you give us an overview of the other side, like what can go wrong? Because I don't want this to be, there's a lot of people I respect in the audience. Michael Green is there, and I do want to point out the risks of crypto and Bitcoin as well, just to make sure that no one makes any decisions based on what we're saying. They see both sides of the argument, and then maybe give the mic to Stock Talk to get his thoughts on crypto as well to kind of balance it out. But Joe, what can go wrong, and what do you think about the fear around Binance, for example, which is very concerning? All the on-ramp, off-ramps that took a hit with Silver Bank and Silicon Valley Bank, and forgot the third one's name now. There's not many on-ramp, off-ramps left, at least not any big. Yeah, not many big ones left. So what are your thoughts on those concerns, Joe?
Yeah, I mean, that's a great point. It will be interesting to see what happens to, I guess, the crypto or Bitcoin native banks. It is concerning that they are, getting closed down or failing or getting shut down. However, what's really happening behind the scenes. So that is concerning. But I think, I know, to me, I look back at like monetary history and I see, okay, worst case scenario, the US banned gold, 1900s. The price of gold still went up. And so I don't think that that's going to happen to Bitcoin by any means. But that is something that, could happen in different parts of the world. Binance, yeah, it is concerning. I think worst case scenario, it's FTX 2.0, where the crypto industry just implodes and prices go down sharply in the short term. But I don't.
What's the latest? I haven't been keeping track for a few months now. After we did that space on Binance. What happened in the last 3 months with Binance, and is the concern level up or down?
So from what I've seen, it's interesting. I guess people have questions around BUSD, which is Binance's stablecoin. I know the market capitalization of BUSD has been dropping at least over the last few months. But yeah, I mean, I think I saw the other day that the Bitcoin price of on Binance was trading at either a premium or a discount. And so there's definitely like some weird things going on with Binance, but I'm not, here to say that, hey, Binance is in a lot of trouble right now or Binance is fine. I honestly don't know.
Why? Yeah. So for Bitcoin to be trading at for arbitrage to exist on the Binance platform, that's the first I hear of this. Is that common? And what does that mean? Is there lack of liquidity?
So what I've heard is maybe it has something to do with their stablecoin not trading at perfectly $1. Maybe it has something to do with USDC not trading at perfectly $1. Or maybe it's people worried that Binance doesn't have the Bitcoin that they have, right? What we've learned over the last 6 months is it's critical to reduce counterparty risk in the traditional banking system and the Bitcoin and crypto world. And so if you have Bitcoin on an exchange, you really don't have Bitcoin. You have an IOU from some startup in Hong Kong that says you have Bitcoin, which is pretty risky. And so the beauty of Bitcoin is you can withdraw it from you to and hold Bitcoin yourself, like you're holding a physical bar of gold in your hand.
Talk. I'd
Yeah,
like
I mean,
to go ahead, Simon.
I cover on the Binance subject, and then we'll go because
Yeah. I'm. That's actually one I'm concerned
Guys,
about.
the casino has
Kevin?
opened.
What do we see?
All the bank stocks are flying. First Republic PRC up 60%. This is its biggest one-day rally ever.
oh god,
PACW, which is PacWest Bancorp, up 58%. WAL, which is Western Alliance, up 51%. MCB, that's the Metropolitan Bank, up 40%. If I'm correct, this is its biggest one-day rally ever. So almost every single bank that was hammered yesterday is up high double digits. And on the top gainers, I do see crypto miners too. HUT, Hudit mining up 21%. That's the only one I see here. Let me look at Mara and Ridegear. Silvergate up 14%. I'm kind of surprised how it's still listed while the other two got
Silvergate
right
up
away.
14%.
Yeah,
So this is my god. This is what happens when you have government intervening in markets, man. What I thought we were a free market economy. This is the exact consequence.
I mean, it's still down 50% on the week.
Think that for 1 second that this is a free market economy. That should have been long been forgotten after 2008. Like, come on, really?
Yeah, I don't know why I said that. Yeah.
Why is 2008 your barometer for that? We haven't been a free market economy for a long fucking time. A long time before 2008.
I agree, but it wasn't clear until then.
This is part of what everybody when we discuss these things is everyone's like, well, that ain't capitalist. Well, wake the fuck up. We live in a central bank ecosystem globally. I mean, none of it is purely capitalist. And so this idea that, you know, there's this free market advocacy on every issue is odd to me because it shows it's ignorant to the fact that structurally the financial system is not a free market. I mean, it has not been for a very, 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 very long time. And, you know, quantitative easing instituted by central banks around the world is providing the liquidity necessary for these markets to function. The whole thing goes kaput the second that you remove that. Now, you know, is it worth saying that over time we should be building towards a free market economy and taking the steps necessary to make the market more free? Yeah, that's a fine thing to say. But you also have to keep in mind that structurally speaking, we have a global economy that is built on the provision of credit and that is built on the liquidity provided by governments. And without that, all of the music stops. You know, you don't.
Yeah, would you agree? Would you agree it's actually impossible to reverse the cycle from here without a severe depression?
Yeah, like when I hear people, and look, like I'm not knocking, you know, I always get people in these spaces that ring my bell when I say anything about Bitcoin. I'm not knocking Bitcoin. I think, you know, in an easy monetary policy environment, Bitcoin will go up just like all of the other risk assets do. But what I am saying is notions like, hey, the United States government will buy it, or, you know, all of these things are silly. There's a military industrial complex in the United States that requires the government to be able to fund it with $800 to $900 billion annually. All of that music stops when the government can't print money. And if you want to use the Chinese government, which is the only other global government that really matters as far as setting international standards, the Chinese government sure as hell doesn't want to forfeit that ability either. Because, I mean, if you think we control our economy and that we micromanage our economy, I mean, it's on a whole different level in China. And so the ability for world superpowers to control the money supply is the entirety of the reason that they are superpowers in the first place. And so, yeah, I think it's nearly impossible to get the United States government or the Chinese government to forfeit their control over their personal money supply. And that's always been my thesis about this whole thing.
But Stocks, my thesis is we take this a step further, which is currently the money supply is only manipulated, and it's essentially created by the banks, which is why we're here at the moment. But the only solution, the only end game here is that the central bank takes full control of the money supply, which is the CBDC narrative. Because
that's inevitable.
We've already set it up, right? Look, what if we just set up? We've set up that every time any run on a bank, the government have to, or FDIC, Treasury, and Fed have to all come together, and essentially they're giving. People are going to, if people take their bank deposits out and end up buying treasuries, then you're giving the bank's business model away, because now people are looking for treasury to limit their bank exposure. So why not just create the money supply direct, let the banks go bust, let everyone download a digital wallet with the equivalent of their bank balance, auction off all the assets, and remove America to what it actually is, China.
I mean, yeah, that would take a long time, and I don't think letting banks.
Well, that will happen at another. If I bet you that would have, if we had a CBDC, and this same event happened, that will be the next response in the next cycle.
I agree with you that a CBDC is inevitable. I think they're laying the framework for it now, but I'm not sure that changes much. I think, to an extent, money is already digitized. I mean, to most Americans,
but it's different. It's created by a bank, created by a central bank.
Yeah, and I'm saying
without debt is
right,
radical banking reform.
The chances that you revoke central bank's ability to print money in the United States or China or any other major country, I think, is zero. I think the chances.
Yeah, no, I'm talking about the opposite, giving it back to the central bank and stop manipulating banks to create the money supply, because it's unstable and you end up with the opportunity for bank runs.
Are you criticizing fractional reserve banking, or are you criticizing central banks, or both?
No, I'm saying that fractional reserve banking inevitably ends up with a deleveraging, whereby the central bank takes back control of the money supply and does what it did with when it funded the American Civil War and creates the greenback, but this time a CBDC, because every cycle is rolled over. You put the debt onto the central bank. You have to increase consumer debt. You have to increase business debt. You have to increase government debt. Then you put it on the central bank, until eventually one day the credit rating can no longer allow for it to do that. And the CBDC seems like the inevitable, predictable, and guaranteed solution to this.
No, it's not.
Yeah,
The
CBDC is coming.
Go ahead, Da Vinci.
Yeah, well, you're saying whether or not the CBDC comes, it doesn't really matter. Money controlled by men, it doesn't matter what it is, whether it's a gold-backed dollar or it's central bank money. It doesn't matter. If it's controlled by men, it will be to oblivion. It will be destroyed. There's rules that can be changed, and when the rules can be changed, right, that means that they're going to change it to create more money. And that's the key thing.
But what about when AI does it rather than humans? Because that's around.
So I wanna quickly go back. Stock Talk. Can you just give us, or Gavin, just sorry to interrupt, guys. Just give us a quick update on the markets. And I want to kind of pivot the question to something else, and that's with bank stocks exploding, what does that show? And we saw a similar recovery in 2008, like we've seen a few times where everything explodes, then collapses again. So we've seen a few dead bounces then. Would love your thoughts if you can.
Are rallying, making new highs. Nasdaq is up 1.8%. S&P 500 is up 1.5%. Dow Jones is now up 1%. As you said, that FRC, which is the first public bank, just got halted.
Is it still trading?
I mean, it's got halted to the downside, which is surprising. So it's still up 47%.
Did you say Signature's still trading? And are they still trading? Why are they still trading?
No, so SBNY, which is Signature Bank, and SIVB, that's Silicon Valley Bank, both of them have been suspended.
Yeah.
Other than these two, all of them are trading, including Silvergate, which is surprising.
Why is Silvergate still trading? How's that? What's the difference? Is it because they
Your
went into
guess
voluntary
is-
liquidation rather than FDIC takeover?
Your guess is as good as mine.
Do you know stocks?
What's that question, Simon?
I was just wondering, do you know why Silvergate's
The
still
only
trading
people
when
who
the
have
other two
the
aren't?
answer is the FDIC. No one else has the answer to that, my friend.
I think the difference is Silvergate went into voluntary liquidation, and Silicon Valley Bank and Signature were taken over by FDIC, but it's the same, isn't it? If anyone knows the answer, it'd be great.
I'm just looking now. Kim would be with his shorting. He'd be screwed right now. Kim.com, because he shorted the banking stocks on the weekend.
Oh, ouch!
I have a question. How did he short at the weekend? The market was closed.
And not weekend. I don't know. The Stock Talk. You were there. I think Stock Talk
was it a trade he did or just a theory?
No, a trade he did. So he went off. Yeah. Stock Talk. Do you remember that?
Stock Talk. I wasn't there. So
Sorry, remember what?
When Kim shorted bank stocks?
Do I remember that? What do you mean?
Weren't you on the space where he says he's going to short the market and he started debating?
Yeah, I mean, I was short bank. I got short bank stocks last week too. I mean, I covered all the positions yesterday. They were up like 400 or 500% each. But I mean, yeah, that was the obvious move, was shorting regional banks.
No, he shorted them. I think what I would tell you. What day is today? It's Tuesday, no?
Yeah,
Tuesday. He shorted them yesterday, I think.
Oh, yesterday? Oh, that was not a good move.
Yeah, he was.
I would assume he would have shorted the stock. He would be down, I would say, 40 to 100% on most of them. So
yeah, if he added them yesterday, that was bad timing. I mean, why would you add them on a day where they're down 60%? That's called chasing. But yeah, I mean,
and that is after the government reassures you your funds are safe.
So stop. Exactly. You caught that 60% move. You traded that.
No, I caught a lot more than that. I was short LOB, which those ran 825%. Those puts yesterday. I was short Wells Fargo. Those ran 180. And I was also, let me go back and check. There's one more.
Are you placing trades while you're on Mario's space?
Yeah, he does. He's always trading. It's crazy. I know it's different life to us.
So that's why like we ask Stocks a question every now and then, and he's just made $1 million shorting a bank.
Made or lost, I don't know, man. He doesn't stop trading.
I do like to trade these things. I mean, I just trade themes and catalysts. Like that's what I do. So I just wait for a theme to emerge, and then I either sympathy trade that theme or just
what's your best and worst trade for the year, Stock?
My best trade is actually on Silvergate. I played calls on Silvergate at the start of the year. Those ran 1,250%. And then my worst trade of the year, had a couple of losers. Let me go back and look. Oh, my worst trade was SQM long that I tried to take, but I took it the day before that Goldman Sachs report came out on lithium. So I got bagged on that one. But that's my worst of the year, SQM options that I took. And then my best is actually Silvergate options that I took back in January.
Joe, do you trade as well, by the way? Joe? Or you're more of a long-term guy?
No, yeah, I don't trade. I mainly just buy and hold.
And okay, so I'm not going to ask you if you're came into the market or not in the last few months. Da Vinci, I don't think you trade either, do you?
I don't trade stocks. No, I only do.
No, not stocks. Crypto as well, Bitcoin and other alts.
Only crypto and alts I trade. That's it.
Oh, okay. Are you in the market now or out? Because based on the feedback, you're pretty pessimistic.
No, I'm still in it. I was just, I'm trading like, even if the exchange were to go down, I'm not going to lose like a whole lot, like what, 5% of my money. So it's not like a big deal. So I always trade with money that I'm willing to lose. Like if I were to lose the whole portfolio, that's the way you're supposed to trade, is trade with the money that you're expected to lose the whole portfolio. And then it's not a big deal. And then you can trade and not have to worry about what happens in the global macro economy or the actual exchange.
And Simon, I want to go to you quickly about Binance again. With the, I know there's investigations. Have they been announced? Are they public yet? Because I don't know what I can talk about and not.
Yeah, there's been the DOJ, and there's been many public investigations.
Which ones are public? Just so I know what I could mention or not.
DOJ,
Into
SEC,
Binance, yeah?
security
Into
state
Binance.
regulators. The DOJ is objecting to the purchase of Voyager by Binance at the moment. They're trying to get through
Not
that.
a big deal.
Yeah. The SEC saying that the exchanges and unregistered securities exchange, Binance US, and that some of the tokens on its exchange are securities. Yeah, but this is the SEC is all over all the exchanges at the moment.
And is there any investigations to CZ on a personal level or not?
I'm not familiar with that. I mean, I hear headlines. It's not something. So the issue with Binance is, and again, this is not about creating Binance FUD. It's that Binance is the size of a significant bank, but it doesn't meet any of the audit requirements. And although little parts of it are regulated with one regulator, nobody regulates the whole piece. And so no regulator can say, I understand Binance. They can only say, I understand this little halo of Binance. And so that's the challenge. And so you've got a range of financial products that, the big, that looks very similar to models that we've seen that have imploded. And I'm not saying anything about Binance's management or anything. The issue is that we've seen this token flywheel model, and the token flywheel model is when you have a token connected to an exchange, and that the price of that token can to some degree be controlled by the same exchange. So you had this with FTX and Alameda, and you had this with Celsius and FTX. The token can be controlled, and so for example, in the Celsius case, the Examiner report showed that 600 million of client money was used to support the price of the token, so executives could sell their tokens onto the community. But it also has a different fraudulent nature in that you can mark to market the token, and that creates this multi-billion-dollar balance that if it went to zero, is the company solvent? And so you could be as big as you want, as bad as you want, as good as you want, but we still don't know how much of the solvency of a company is dependent upon that price. Now, when you also have the ability to control the price because you're an exchange operator, a sign of a lack of confidence can crash that token, like we saw with the FTT token, and expose all sorts of stuff. And so we don't know that is the main point. I'm not making any kind of accusation. It's just that it operates like a small private company, but it's too big to fail, and nobody has a full understanding because proof of reserves is it doesn't solve the complete piece, and that's the challenge. And it's not like it's operating, for example, like a custodian where you're just, there are lots of different financial products that are intertwined. You can lend those products for derivatives. And that's the issue. So it's just this one big, risky company that nobody has a clue about. And you can be a big Binance fan and be really, really big CZ fan, but no one can say with a good degree of accuracy that they understand the risks in that business. And could it survive BNB being speculatively attacked to zero? Well, that took down FTX, that took down Celsius. Would it take down Binance?
But you can't compare. But comparing FTT and BNB is not fair, considering the utilities of both are very different.
No, that's the security argument. So is it a security? Yeah, is it a security is based upon whether it's got utility or not, or whether it's got use. The argument of marking the token to market on your balance sheet and that being a multi-billion-dollar asset that you rely upon for the solvency of your company, what would happen if it got attacked? Then are you still solvent? Have you marked it to zero? So, I'm a shareholder in Ripple Labs. I'm not a big fan of the project at all. I invested in it a long time ago, but they don't mark XRP on their balance sheet. So, their shares trade on the Bank to the Future secondary market at about $10 billion at the price of the last funding round, and they've got over $16 billion of tokens in their company, but they don't mark them to market. So you know and you understand that risk. We don't know what the exposure is to BNB token. Now, you might say, well, it's got utility, so therefore the price will be supported. But that's kind of the same with many of these banks, right? There's these black swan events that expose something that can be attacked by a hedge fund or a speculator looking to profit from that. And we don't know that. That's a risk in the market.
And if Binance does go down, other than crypto dumping, fundamentally, where would the industry be? Like, I just don't understand how we could recover from after FTX, after
we
the
recover
banks.
because our business is not dependent upon exchanges. Our business is dependent upon
It is
Bitcoin.
for liquidity. It is for liquidity. It is for UI.
Yeah, but sure, but other exchanges come along. That's just free market capitalism. Another one will come along, just like an exchange can't get banking right now. Another exchange will be able to get banking, and that's just a market force. It's a challenge to our industry. I mean, these are big problems to solve. But yeah, it's just another one of those events. But the fundamental of our industry is Bitcoin decentralized? Does it allow you to own your own money, spend your own money, and does it have a fixed supply that can't be changed? Well, we've seen every type of attack. Then you have service providers and companies and the crypto industry build around that. All of that is services to try and grow the industry. But the core of the business is, can you take down proof of work? If you can take down proof of work, then we don't have an industry. But every other company is just, for example, USDC depegs, everyone starts buying Bitcoin.
Hold on, this quick question. Didn't someone just send me a message? Didn't Kramer tell people to sell Bitcoin yesterday?
They did.
Yes.
The poor guy, I don't understand. Is it just, I know people are just picking his losses, but does he ever pick winners? Because it's the impression I have is like,
it's been a real tough season.
I mean, he does. He was long Silicon Valley Bank.
The internet and the memes have only amplified almost bad take after bad take, and I'm sure that has a big part to do with it. But like, I go back and forth between it being comical and just unreal that from optics, from appearance, that virtually everything that is being said on a big name or a big position literally goes the other way. I mean, for Christ's sake, there's literally an inverse ETF now. There's obviously a long ETF, but there's an inverse ETF on these picks, and like, what a better way to show like where we are in markets and investments with and kind of the convergence of internet culture, memes, and Twitter with like real world trading. It's insane.
I thought the inverse Kramer thing I thought was a joke, but it just, every time he does something, people post about it, say, hey, do the opposite, and then ends up being right. And something
Mario,
to the extent
more than a meme.
To the extent that ETF really does track those things and doesn't have a lot of lag between, I guess, figuring out what to short or go long on based on his recommendations is one thing, but you can now place your bets accordingly and check out, and if not, at least see the performance of something that's hopefully close to the opposite of what he's saying. And just wanted to bring something up real quick. You mentioned DOJ and investigations, and you guys probably do know about this, but Fed, I think yesterday, announced that they're doing their internal investigation on SVB collapse. Just for anyone who's like interested in when that would be made available. They're looking to release final results to the public on May 1st. They want to review how basically well regulated, this is the Federal Reserve's investigation, how regulated and supervised SVB was, before their ending here. So May 1st, everyone, mark your calendars to the extent you care what the Fed has to say.
On DOJ investigations as well, it was announced yesterday. That
that's going to be
a Terra Luna one as well.
That's the juicier one, I would imagine. You got the DOJ, you got the law actually, on your back. That's the criminal stuff. So you'll be hearing from multiple authorities.
The Bank of England just came out 4 minutes ago. The Bank of England is going to give evidence on Silicon Valley Bank UK to the UK Parliament Committee. Not surprising. Gavin, you were jumping in with something?
Yeah, so I did think the Jim Cramer thing was a joke, but if you look on top, it's been a was Cramer ETF went live, and it is outperforming the market by 5% so far.
Jesus,
so
there you
the
go.
actual performance and data backs the memes. In the first couple of months, when I saw these memes, I was like, has to be a joke. It's impossible. How can someone suck so bad? Like, this guy has been doing this for 40 years now.
And he's got such a reach.
Yeah.
I've got some. I want to get you guys. Let me get Gavin. Give me your thoughts on this. And Nouriel Roubini said the following: the real and financial economy are contradicting each other. The government created a mess of too much debt and started another leverage cycle. The Fed has been doing backdoor quantitative easing. Our financial system is reckless. Would love your thoughts, guys, on this, Gavin.
I think Douglas might be a better person to start the conversation.
What do you think, Douglas, on what Nouriel just said here?
Say it won't. I was responding.
Yeah, I'll read it out. I'd love your thoughts in name redacted. So the real and financial economy are contradicting each other. The government created a mess of too much debt and started another leverage cycle. The Fed has been doing backdoor quantitative easing. Our financial system is reckless.
We talked about it basically being financial QE either 2 nights ago. Is backstopping the banks here pretty much QE for financial institutions, and they'll continue to tighten on the retail side of things. I think the first half of that's pretty accurate, that there is a discrepancy between the real economy and what's going on in the world, in the financial world. But the broader theme of that is the financialization of just about everything, from pre-2008 to where we are right now. And I guess he's asking, as that gap widens between, real and I guess artificial, how many more, fissures and cracks are going to begin to appear, and who's going to ultimately get hurt by that, and how bad are they going to get hurt? So, a smart guy, obviously touching on themes that most of us would agree do exist. How far and how bad that rabbit hole goes is speculation. I mean, not everything bad leads to cataclysmic recessions and depressions. It could very well be recessions and breakages that need to be repaired. But it does seem that the further and further we go down the road of financialization, the more Main Street becomes disconnected. We can point to a lot of things that do that. The one that comes to my mind is when you had, this is with residential real estate or really in general, during a low rate environment, you had BlackRock and other financial institutions scooping up real estate, all cash deals. How is that good for the middle class, right? How is that good for the American dream of home ownership when you now have institutions holding on to real estate forever, I would imagine? What are they going to do with those properties in terms of packaging them into securities, whether it's residential REITs or just as assets to collateralize other types of financial instruments? Those are the types of things I think, just how broad what he's saying, goes, and just how deep financialization of the world has become. And if we're not careful,
Yeah, let me just jump in quickly because I want to get Name Redacted's thoughts on the CPI numbers. And Name,
Go for
you've
it.
been with us for the last few days and giving us a lot of insight. So I want to read out what Robert Pavlik, Senior Portfolio Manager at Dakota Wealth, said. Both, I'm going to quote exactly what he said, both the headline and core CPI number probably continue along with the thinking that the Fed is likely going to be either pausing or at the very least raising by only 25 basis points in the next meeting. If the Fed's more concerned about credibility, then they're going to have to raise by at least 25 basis points, which is, I want to say the consensus, but most people on the panel have said this is what they expect. But I think the credibility concern is probably secondary to the concerns about the overall market. I think they're going to probably be on hold because they're worried about the issue of contagion and the precarious position that it puts the banks in with regards to their balance sheet. If the Fed's worried about saving face or coming off as wishy-washy or worried about losing credibility with the market, they're going to raise by 25 basis points. I think that's what they should do, but they probably won't. So my question to you, Name, of course, what do you expect to see? But more importantly, if they raise or if they keep it the same, what difference would that have what impact would that have on the markets?
Well,
and then, of course, I want to go I want to go right after you're done. I want to go to Stock Talk and Gavin just for a quick market update afterwards. But yeah, go ahead, Redacted.
yeah, I mean, I said over the weekend that I just found it, I couldn't comprehend that two banks failed or were shut down. And then the Fed, a couple weeks later, and the Fed also announcing like an emergency or sort of, another one of these emergency bond or bank lending programs similar to, not as large, but, similar to the ones they brought out during the financial crisis. Again, not comparing this to the financial crisis, but with that BTFP program where they allowed the banks to post, as collateral, all these these mortgage-backed securities and treasuries that they're underwater on. They allow them to post them as collateral at par, to borrow against. So I couldn't comprehend them raising rates after all this has happened. But having said that, the market right now is pricing, it looks like about 80% odds of a quarter point hike. The only problem with moving forward, because the inflation came out today in line, it's still running at 6% or whatnot. So if they pause now, the problem is, can they with inflation continuing to run hot, can they resume by starting to raise rates at the subsequent meeting, right? So I saw Nomura came out, predicting that they were going to cut rates. I do not think that was happening. We had Michael Green, or I think that was his name, last night, and he said the same exact thing. That would actually probably cause a panic in the market. Like, why are they taking a drastic measure? So I don't see a cut happening. I would say somewhere between point hike. If they want to stay on track with inflation numbers, although they weren't terrible today, then they would just hike by a quarter, because the consensus last week prior to the Silicon Valley Bank going down was, 50 basis point hike, right? So, but I don't know, back to like what, but then again, here's another thing too. You have Credit Suisse, credit default swaps are blowing out to like, their all-time highs today. So they're like at 100 basis points. So I guess was Credit Suisse hit.
Sorry to interrupt. I just a headline from CME Group here. I pinned it at the top.
Is that the all-time high record from Monday?
Monday saw the highest daily trading volume on record. 66 million options contracts were traded yesterday, which is a fuckload.
How would you interpret that, guys?
I mean, look, this is, I think, in line with the same thing that we've seen in zero DTE trading, the surge in zero DTE trading. We talked about that a couple of weeks ago. But, zero DTE trading just prior to the last few years used to make up anywhere from 15 to 20% of total nominal trading value on SPX. That number has gone from 15 to 20% prior to the last 2 years to up to 55 to 60% of total nominal trading value is 0 days to expiration. So for people that don't know what zero DTE is, they're contracts that people purchase that expire within the same day. So I imagine this has something to do with it. But yeah, CME Group.
Well, they just changed that stock. They just changed that recently, where, I mean, they used to have zero DTE was like, I believe it was like either Monday, Wednesday, Friday, or Tuesday, Thursday. And then they just recently changed it to every single day there's zero DTEs, correct? Yeah.
Yeah, they
On
changed it, and for certain, for SPX, but for individual
So
names.
stock dog, that is incorrect. So the
What's
CME
incorrect?
volume mostly came from SOFR, which is the secured overnight financing rate. Future was 15 million. That's what caused the big bump.
Oh, I thought you
not
said
the zero
CMEs.
DTs.
Oh, okay. Well, I mean, I didn't break it down, but
Yeah,
I was
okay.
just, I imagine that has something to do, the surge in zero DT has something to do with the surge in short-term trading. But yeah,
So
66
if you look at the press release, they said this is due to volatility. March 10th, which was last week, was the fourth highest with 56 million. So it isn't unexpected, but it has been moving higher. The average.
And
every
how
single
guys,
day.
how are the markets looking? Can you give us a quick update there? Are we still seeing a nice
the
recovery?
market, you are seeing a little pullback in treasuries today. So the 2 years out, 2-year rates out 35 bips today. So it's back around 4.3%. So you're seeing a little bit of a correction from yesterday where you saw sort of a huge flight to safety and all the financial stocks were like tanking, the banking stocks. They're rallying sharply today. They've actually rallied like First Republic so much on the upside that they've had to halt it for circuit breaker.
That's crazy. That's crazy.
But
and
I
then
mean,
let me read this out from. Let me name. I'll read out what Gina Bolvin from the Bolvin Wealth Management Group said. Today, CPI came in as expected and has given the Fed flexibility. They should pause and give guidance that they will reevaluate. Silicon Valley Bank failure is a game changer for them. So she's in the camp that SVB is enough to have the Fed pause. So do you agree?
I do agree, but I don't think it's as systemic like a financial crisis situation because it was a bank run, a loan.
But a bank run itself can be a systematic.
Yeah, I mean, it obviously could. I mean, for sure. But it seems like a lot of people that were, like the David Sachs and Calacanis and Bill Ackman, everything they're calling for over the weekend, they got it. So they got that unlimited insurance on depositors. So that hopefully that addressed that issue and we're fine. I mean, we saw a big bank sell off yesterday, but now that they're all correcting and they're all ripping today. Like all these banks that were down yesterday, they're up 50%. They haven't made back everything, of course, but they're bouncing back hard today. The XLF's up 2.5%. So,
Raphael, where are you at with everything we've seen today? It's been a good day, man.
It's been a very good day. Actually, I haven't seen a lot because this night was the first night I've slept since Friday. And I'm not saying that in an exaggerated sense. I actually didn't sleep for almost 48 hours straight. That's from Friday. I think I got a little bit of sleep on Sunday. And I'm very, very happy to see the news this morning with the strong rebound in regional banks. That's really, really fantastic news. And I'm very happy. I also see in your heading that Bitcoin breaks 26K. So that's also good news. It's kind of strange to see both of them rise at the same time. They sometimes go at odds with each other. But yeah, the news is good. As far as CPI goes, I think CPI, it's still, I don't know how real time these reports are or how lagged back the reports are, but seeing that, there's still rises going on, like the way they frame the news saying that, oh, it didn't rise as much, but, putting into context that it's still rising. I think there will be a cooling effect from what happened in the last week with all the regional bank crisis that we've seen, because no matter what the Fed does internally, there are going to be regulations down the line. I think everybody knows this in the banking sector, and just all the banks are going to be tightening up. No, liquidity and credit is going to seize up a bit. So I feel like there's going to be a cooling factor, and I think the Fed would be in a good position to just go up quarter of a basis point instead of half a basis point, which I think that's what the market expectations were up until now. But I don't think they're going to. I don't think they're not going to do anything.
Correct. Yeah, I think the market is pricing an 80% chance of quarter point hike, but I mean, we still have a week, so we'll see. But another thing too, as far as CPI, just remember, I think 32% of that is the owner equivalent rent component. And Douglas, maybe you can comment, or anyone else who understands, but that is a very lagging indicator. The CPI is lagging, and I believe, I don't know exactly, but it's at least a 6-month lag on that metric alone.
Yeah, yesterday, last night, it was brought up that not only is it a lagging indicator, but for all the hikes that have been done here, are we how much compounding has been done of that lag, given how quickly and ferociously the Fed has raised rates. So is this, I think we're all kind of wondering, is this print the one where you see that deceleration of inflation now really start to pick up and the effects of these rate hikes really begin to kick in? If that's the case and you start to see that happen, I guess on the next print, that's going to be bullish, right? So the Fed is going to see the effects of their rate hikes really start to impact inflation in the way that they want. On top of this drama with the banks, could very well be a setup for rosier equity markets here. I'll leave crypto out of it. It seems to be its own thing, really cool and fun to watch. But if these rate hikes and the lagging effects of inflation all start to compound and start to show up here on forward, the Fed is going to get what they want, and therefore, equity investors are also going to get what they want, because it will bring about the pivot that they're wishing and begging and hoping for here. So you could rip. That's one case. We heard a lot of people bring up some very pessimistic doom and gloom cases, obviously justified in their view after what they've seen. And that's what makes a market, guys.
Douglas, what do you think the ECB is going to do on Thursday?
Guys, breaking news. The SEC has started an investigation against Silicon Valley Bank.
Well, I don't know if that was for a good reason or not, but what was the question?
Oh, okay. Go ahead. Sorry, Gavin.
So the SEC has started an investigation looking at the collapse of Silicon Valley Bank, along with the DOJ.
Well, it shouldn't come as a surprise, but yeah.
So I actually think there may be some pressure now, not some, but a lot of pressure based on public sentiment and what's happened for the last 10 years, where Wall Street keeps doing whatever they want, the rich, the banking sector keeps doing whatever they want, and no heads roll, there's no accountability. So I find that if there's a headline like that where certain things are being done in terms of a criminal investigation, if there is wrongdoing that's found, I think there are going to be examples being made this time. Even if it's something that's closer to being benign, that's worthy of a slap on the wrist, it may come down hard, because the public pressure is very strong against this view that the rich keep getting away with it.
Headline is their DOJ is investigating the stock sales made by the executives.
Good.
As
good.
Part of it, which is good.
Yes.
So we can get some,
Real quick on that. I can't tell you how far that it would go. Let's first of all assume, on the assumption that there was, wrongdoing and criminality with regard to those stock sales, and let's assume that gets found out and there's charges. I can't tell you how far it would go in light of how little action was taken post 2008 for the public to see that, hey, play stupid games, win stupid prizes. In this case, sell your your stock into a run and collapse of your bank pay bonuses doesn't, kind of at the surface looks really bad. And it turns out that indeed was the case. It would go so far. I truly do think it would go very, very far in the eyes of the public. It's also a very delicate narrative here because you're now, you got criminal charges against people who ran a Silicon Valley bank. So it's really not good. So on one hand, it would go well for the public, but it would feed a populist narrative, right? That rich VC bad. They do crime, and really screw us over here. So if it's not, yelling at the banks like in 2008 and 2009, they're going to be yelling at Silicon Valley and venture capital here. And very, very similar undertones between the two. So kind of careful what we wish for, because we all know that that's not really, when you look at the brighter spot of Silicon Valley in America, that's all really good stuff. But it's going to be, I would think, if there was criminal activity and those charges came down and people were held accountable for that, it would go a long way in reversing the almost nothingness of 08 and 09.
I want to quickly go to just a few more quotes on the CPI numbers. Let me read it out here. Services inflation is still hot. The Fed still has work to do, and their actions and communications are going to come under increasing scrutiny given the events of the past few days. That's from Andrew Patterson from Vanguard. They need to be careful in balancing the risk of price and financial stability. But I have a question for the panel. If they go up by 50 basis points, could we see everything reverse again and the markets dump? If we see 25 basis point, do we see stable markets and improvement? And of course, if they don't increase at all, what can we see? Just so for the audience to understand, like when the decision is made, what we should expect to happen afterwards of the markets. Obviously, we can never know for sure. Just speculating what we could expect.
Yeah, I mean, no one can know for sure, but generally speaking, better than expectations inflation is going to be received positively by the market, and worse than expected inflation is going to be received negatively by the market. The point I was making earlier about the United States Federal Reserve being a dual mandate central bank is that it makes the function of the U.S. Federal Reserve a little bit differently than most central banks. Most central banks only care about price stability. That's the only thing on their chartered mandate is price stability. That's all they care about. Now,
have they been politicized, those stock talk?
What do you mean? Have banks been politicized? Central banks?
No, you talk central banks. Like, yeah.
Yeah, it depends. I think to varying degrees. I would make the argument that central banks like the Bank of England and the Reserve Bank of Australia are a little bit more politically leaning than the United States Federal Reserve. That being said, the United States Federal Reserve has had instances in the past where it seems to function as an extension of the rest of the political body. But they do care about their mandates, or they should care about their mandates more than anything. I mean, everyone saw Powell's testimony to Congress, right? He's getting grilled by people that are like, hey, you're going to cause more unemployment. Isn't that your goal? Like, you're putting people out of work. Don't you feel bad about that, et cetera, et cetera. And Powell's sitting there shrugging his shoulders like, you guys are fucking idiots. You don't even understand what our job is. And, without the Federal Reserve, you would be in a situation where you'd have runaway inflation. You'd be in a situation where economic crisis wouldn't be able to be addressed. Now, are there other solutions to that? Sure, we can have a deeper conversation on that. But while the Federal Reserve is here, people care about their ability to address their mandates. So if inflation comes tumbling down, yeah, that's bullish for markets. At the same time, markets want a lower than expected hike next meeting. Goldman said they don't expect a hike at all. Some other banks said they were expecting 50 and now they're only expecting 25. From my personal preference, I'd like to see them hike 50 and just get this over with. From other people's perspective, they want them to be patient and see the implication that the hikes have had. I just don't think that this is a demand-driven inflation problem. I don't think it is.
So guys, it's Foss. Look, the third mandate of the Federal Reserve is financial stability, okay? And if you guys don't think that the financial stability of the U.S. system was stressed this past weekend, then I don't think you're paying attention.
I do think it was, but I don't think.
Okay, inflation compounds. No question, inflation compounds. But if the Fed is going to raise 50 basis points going into this financial instability, they are compromising the most important part of their mandate, which means continuation of the
Boss,
federal.
Explain to me, besides the fact that a bank failed, what is the implication of financial stability there? Like, what specifically is financially unstable? What's
the depositors' confidence in the system, because banks are inherently over levered. 25 to 1 times leverage equity to their assets is not responsible, but it is the nature of commercial banking globally. So when you have a bank run, it's because people are worried about the stability of the system. What causes instability? Credit risk and interest rate risk.
This bank run had nothing to do with the stability of the system. This bank run had to do.
What are you talking about? Why would you think?
I just want to agree with Floss for a second. Stock. You don't think I understand what you're saying, but now that we're in it, you don't think the stability is at risk? If yesterday it didn't go as well as it did.
I'll answer your question. Do I think regional banks are at risk of a similar silver bullet that was shot at SIVB? Yeah, I do think that risk still exists. But I think that risk was a known factor in commercial banking well before this happened. Every bank in the United States is exposed to long-term treasuries. And if you look at the held to maturity, all of those banks are underwater on those long-term treasuries. If you go look at a chart of unrealized losses across all U.S. banks, none of them can afford to realize those losses. The thing with JP Morgan and Bank of America is that they have tens of millions of retail clients that aren't going to all show up at the bank at the same day. So they're prevented from ever having to realize those losses. So there's a difference between a contagion being relative to an industry and a contagion being relative to the entire financial system.
It's all the same mathematics, guys.
No, it's not.
It is 100% the same. Well, then you're wrong. Because
I'm saying your implication is that some instability in the financial system caused this bank run. That is objectively not true. What caused this bank
man?
Run?
Come on. Look, you see,
Sentiment matters.
That's factually not what caused the bank run. This bank run was caused by a bunch of people sitting around saying, wow, the economy is unstable.
What this exposed is the fragility of the system. Sentiment matters. Financial stability is psychological. You can't rip the Band-Aid off and take half the skin with it. It's gonna hurt. You don't want to be so aggressive in such a serious matter.
To answer your point, this only exposed fragility in the financial system to people who were not privy to the exposure of banks to treasuries before this happened.
That's 99% of people. You think everybody sits around on Twitter Spaces, being finance bros?
I'm not saying that they do, but I'm saying to those people, sure. Now maybe some more regular people are aware of the exposure of banks to treasuries, but
which, by the way, makes this even more fragile because now more people are aware.
But hold on, the solution to what you're saying would be to tell big banks not to be exposed to long-term treasuries, and that's not going to happen. So as long as big banks are exposed to short-term treasuries, the insolvency risk exists. Period.
No,
I'm just saying you can't take the Titanic. You can't take the Titanic and make sharp turns. The dinner plates are going to fly all over the place. You gotta, ease it up a little bit. And right now, based on what happened this week, I think wounds are raw. The markets are very, very touchy. That's why a gentler touch would definitely be the right thing to do. I understand what you're saying, just land the ship. We're going in the right direction with the CPI. Just pull off the Band-Aid. But I'm telling you right now, if the wound is sore and you pull that Band-Aid off, there's going to be blood on that Band-Aid.
So I want to put out a statistic, and then maybe people can comment on this. So going back to Silicon Valley Bank, on their investment portfolio, their securities that they hold, this is from their 10K, okay? Their year-ending 2022 10K, okay? Their hold-to-maturity securities of $90 billion. The weighted average yield on that $90 billion, it was 1.66%, with a weighted average duration of 6.2 years, okay? The 2-year treasury yield has been above 2% for a year, okay? The 90-day T-bill alone is yielding 4% or so, okay? So what did we think depositors were going to do? Okay, I mean, and if you look at anyone here, everyone has a bank, right? What interest rate are you getting on your checking account or savings account when, and if you're at a big bank, you're not getting much, okay? So why would you
name? Are you alluding Are you alluding to the fact that depositors are now essentially taking risk while not participating in upside? Is that your implication?
No, I'm just throwing out some statistics, but I'm just saying right now, I could go into my broker or whatever. I can go buy directed issue treasuries at 3-month treasury for 4.9% right now myself. So why would I keep my money in a bank yielding nothing at a big bank? I mean, I'm just saying, like,
I don't think that a rise in rates and higher treasury yields is going to dissolve commercial banking.
I'm not saying
I just don't
that.
believe it.
It's not going to dissolve.
I'm just throwing out a fact on a statistic on the books of what was.
Go ahead, Michael.
Yeah, no, what I was going to say is, no, it's not going to destroy commercial banking, and it's certainly not going to destroy it overnight. But that is exactly the issue that's happening. By raising rates and creating an alternative to bank deposits and to equities and everything else, you're drawing deposits out of the banking system. The real issue for Silicon Valley Bank is that there is a maturity mismatch, as there is in all banking. Deposits can leave tomorrow, and your loans are long in nature. And when interest rates go up, the duration on the portfolio that Silicon Valley Bank bought, they thought it was going to be a 3-year duration because people would normally refinance, et cetera, as they've done in the past. They made a miscalculation. So they had very long duration assets, as does much of the banking system. As you pointed out, there's huge losses. And now the question is, do enough deposits get drawn out that they have to start to realize those losses and impair their capital? That's the key question.
That was exactly the point I was making. And Michael, thank you for articulating that a little better than me.
Yeah. I agree. I agree with that, right? This is a function of risk to deposits. However, we've already seen it. There's a Financial Times article this morning, to the extent that you believe they're reporting. It's Financial Times article this morning that the big banks, Bank of America, JP Morgan, Citibank, are already taking steps to accelerate their sign up and transfer processes because they saw a massive surge in new customer demand, in the fallout of this regional banking crisis. Do I think there's exceptional risk to regional banks and they're more susceptible to a bank run? Yes, I believe that. Now, do I believe that this is going to lead to the collapse of the commercial banking system? No. So I think, there's a fine line here between hyperbole and realistic contagion. I still think commercial banks are at risk, despite the rally back today in names like FRC and PACW. It just depends on how susceptible they are to actually inducing a bank run. And the unique thing about Silicon Valley Bank was all you needed was 10 phone calls. Right? You need 10, 15 phone calls between these venture capital firms to tell all of their guys to take out money. That is much harder to do when you're talking about 5, 10 million Americans. That's harder to do. They're not all going to call each other, right?
So that is absolutely correct. And that is exactly why Silicon Valley Bank went first. But what we actually just did over this weekend is raise a giant red flag to the American public that says, hey, guess what? The reason this is happening is because you can make more on a money market fund than you can on your bank account. I guarantee you, any number of people called me this weekend saying, is that true? Most people don't pay attention to this stuff. Now they are.
So guys, Michael, good to hear from you again. Look, at the end of the day, there's BIS capital guidelines that are predominantly set to manage credit risk within the banking system. Okay. This was an interest rate mismatch. This was lending long and borrowing short with an unstable asset base. I agree. But the reality is the banking system is undercapitalized for the true risks of the entire interest rate risk and credit risk spectrum.
Do you think tier 1 capital ratios should go up, or do you think reserve requirements should go up, or both?
100%. The BIS guidelines will reverse.
How much?
Probably double, probably at least double, having studied this for 30 years. What's that?
You've lost your mind if you think they should be doubled. I mean, it's just...
Sorry. Having worked in it for 30 years, I guess I realized at the outset it was wrong, and the BIS guidelines were reverse engineered.
You think the tier 1 capital ratio requirements should be doubled?
Yes, sir.
I mean, I just can't even respond to that.
Okay,
I'm not sure I would.
Why do you think they should be doubled?
Yeah.
Because 4% equity capital against credit risk does not include a sufficient reserves for or sufficient capital for interest rate risk and operating risk within a bank. Okay, The BIS capital guidelines were reverse engineered to largely keep the capital that existed in the system before 1987, 1988 in line with what the BIS capital guidelines came in with. Very simply, you run a portfolio. Tell me that on a regular portfolio of credit risk, that the change in mark-to-market valuation of any credit portfolio does not change by more than 4% at any given time, which means your equity capital can be vaporized in any credit cycle. Well, then you're wrong. So it has to at least be doubled, which means the profitability of banks will be halved, which means part of the fiat Ponzi, which is the mechanism of the banking, the commercial banking system, yes, has to be reverse and or not reverse engineered, re-engineered. Very simply. That being said, it's not going to happen because then the profitability of the entire banking system could be compromised based on the DuPont formula, right? Return on capital equals your return on assets, and then your gearing ratio, assets over equity. Okay, so at the end of the day, you can't change your gearing ratio without changing materially the profitability of your banks. And that'll be a huge issue. So you'll either get bank runs, you'll have two extremes on the spectrum. You'll either be whistling past the graveyard or you'll have bank runs because people lose confidence in something that is levered 25-1. It's that simple, guys. I'm sorry.
Michael, I mean, is that even, but based on what Foss is saying, is that even realistic in terms of from an application point of view?
But I think the direction that he's pointing in is right. What you're likely to see on this is exactly what people were alluding to with the Bank of America, JP Morgan comments, et cetera. You're going to see a massive consolidation of the banking system.
I have a question for the panel.
Consolidation, Michael. Sorry, just to jump. And consolidation is good because it removes inefficiencies in the system. You don't need as many credit officers. You have, you can remove all the costs from the system. But eventually, and in Canada, where I live, we only have 7 national banks, right? So the rule of 1 in 10 would imply that the USA could get by with 70 national banks. That potentially is the case, but it's just a very different banking system in the USA where you have community banks lending to, community businesses and farm banks and all that. So it won't happen easily, and it won't be without a lot of pain in the system.
I can't believe Greg Foss just told me how important centralization can be.
Hey, I'm not a centralist, but in banking, commercial banking, it's better than a lot of these. There were 12,000 banks when I went to school down there, Michael, and now there's 5,000. And I would venture that 4,000 of them are run by people that don't actually understand the true risks of banking. That's a danger.
What about
to the
competition?
system.
What about pricing to clients? If you have centralization, then what about that nature of the whole business aspect?
You haven't seen it in banking. The problem primarily is that it is largely a local business. And what Greg is pointing out is that it works well as a national business, or reasonably well as a national business in countries like Canada, where you have a significant non-banking financing component, right? Things like credit unions, et cetera, which are not counted in the numbers that he was referring to. But the primary issue that you have in the United States is it's a question of how does the consolidation occur? Does it occur because you are effectively forcing the small banks out of business? Does it occur because the large banks are offering more innovative services? We're certainly not seeing the latter.
So one question I had for the panel is the BTFP. So that's providing some short-term relief. How do the banks unwind themselves down the road? Interest rates, are not going to go to zero, I assume. So what's the long play here? How do banks fix the balance sheet issue with these bonds down the line?
Well, I need to drop down, and I want to thank you, Mario, for inviting me. And as always, Michael, I enjoy our lively discussions. At the end of the day, okay, the reality is once you have taken the deposit insurance basically up to everybody's insured, I feel it's going to be very difficult to walk that maximum. That being said, again, I just want to stress the difference between interest rate risk management and credit risk management. Largely, if you run a matched maturity marginal value of funds pricing mechanism within your bank system, meaning your cost accounting basis, you will not run an interest rate gap like the Silicon Valley Bank was exposed to. But lots of banks do, because it's very profitable in a normal shaped yield curve where you're borrowing short and lending longer, and in an upward sloped yield curve, you generate the interest gap. But risk management is always going to be paramount within the banking system, and predominantly it's focused on credit risk up until now. Well, this interest rate bit them in the bum, because why? Well, for 40 years, interest rates went in one direction. So it's going to be a very interesting scenario here, and more people are going to have to monitor the banks much more closely as to their true risks up and down the spectrum, which include interest rate risk, credit risk, and operating risk. I really, really want the USA to solve this, okay? I'm a Canadian looking in from the outside. I want them to solve this, but this has been at least a 40-year problem that just continues to get kicked up the ladder with each successive financial crisis. So thanks for having me, guys. It's been a great discussion.
Before Greg drops down, I just want to echo what he's saying. And it's not just a function of this risk exists right now. Part of the problem is that all of the systems for risk management and risk monitoring that we have, things like financial conditions, indices, are focused on the spread component. None of them give any weight, zero weight, to the absolute level of interest rates, which is exactly what Greg is pointing out has become the systemic issue at this point.
I mean, just one of the points you mentioned, what is the problem with basically the banking system becoming centralized and not having too many regional banks who can basically make these type of decisions and cause problems?
The primary issue is that it is more challenging for small entrepreneurs to obtain financing. Right, because you do not have the personal relationship, because you do not have the geographic focus, because the cost of doing a loan or underwriting a loan is basically the same, whether it's $1 million loan or $100 million loan or a $10 billion loan. The larger banks naturally gravitate to writing larger loans. And so you separate and bifurcate very rapidly into very low cost for large incumbents and high cost of capital for new entrants.
So exactly what Michael said, and a lot of questions came towards me yesterday about Signature. The reason why I was at Signature, well, there's two reasons. One, I wasn't at Signature at my current level. I was originally at Signature many years ago when my deposit balances were a lot smaller. But actually originally started with what Michael just said. We were looking to purchase an asset. And I don't remember, I was with JP Morgan or Bank of America or someone at the time. And I just couldn't get the time of their day. You know, it was like a couple of $1 million. They didn't really care. It's like, okay, send us this, send us that. It's just like a whole bunch of stuff. And my attorney said, you know, I know a very good senior person at Signature Bank. I think they should be able to wrap this up for you relatively quickly. I'm like, who the hell is Signature Bank? And then I went, you know, we had like discussions, and it was such a night and day difference, the process that I had with them, where I submitted my books and we did their due diligence and everything went very smooth. And ever since that, it was just a really, really smoother relationship and operation. And they really met my needs, and it was a really good personal relationship. And loyalty also matters. You know, sometimes you have a relationship with an entity for a very long time, and you stick with that. You stick with that company. So that's how a lot of these deposit bases for Signature Bank, they started in 1999, and they went from zero to what they were at, like almost 90 billion in deposits around end of 2022. So yeah, it's a different experience.
But I mean, the question is, I get that. So what you're saying is they have very good customer service, they have very good customer relations. And what Michael said is, when it comes to new businesses or in the tech industry, though these banks are willing to basically essentially take more risk. I guess the question is that worth it to have the risk of the entire banking sector collapsing is what we almost saw.
It's not just more risk. I understand what you're saying, Suleiman. It's not just necessarily more risk. It's just resources in terms of time and having the knowledge in the locality of where you're operating. So, you know, if you're in a JP Morgan Chase, you're competing against Microsoft, you're competing against Twitter or these gigantic monolithic entities. You just, as Michael said, are not going to get the same amount of time and attention because resources are limited, and they're obviously going to go default to the multi-billion-dollar corporations than anyone that's smaller.
The other thing that I would just highlight is that there's alternate risks of credit, right? So if you are in your local community, obviously it's harder to, survive the dynamics of having lied to a creditor, to a bank, than if you're doing that at the national level, right? So fraud is both simultaneously easier and at the same time harder because of the community connections. There's a more holistic definition to it. There's also terrible components around it associated with diversity, equity, and inclusion, which I'm sure this group is somewhat negatively disposed to, but has been a legitimate issue in the U.S. banking system and other banking systems. Europe is 10 times worse throughout history. So all of these are issues that people have tried to think through and address. And the hard part is that it's complicated, right? There is no easy solution to any of this stuff. If there were, we would have come up with it.
So, Michael, do you know how one may go about the process of some options of winding down these the long-term play on BTFP is? So there's short-term relief, but what happens a year down the line? Because as we spoke, even Bank of America has exposure to this kinds of issues.
Well, it's not even Bank of America, right? So Bank of America is one of the primary deposit taking institutions. They take in significantly more deposits than they can generate in terms of loans, which is exactly the issue that creates what Silicon Valley Bank went through, right? There's just nowhere near as much demand for their loans as there was demand for their deposit taking services, which is why they go out and they buy secondary market securities. So Bank of America does the exact same thing. And it was one of the primary contributors, by the way, to the components of the global financial crisis.
Right.
This, as I said, this is really, really hard, right? There is no easy answer to these things. What you have done is you have acknowledged with BTFP that many banks are facing these types of liquidity crises, given the level of interest rates that are drawing assets out of banking deposits, even as the banks themselves, because of the low yield on their portfolio securities, cannot generate enough to pay high interest rates on deposits. And so this is a stopgap approach that basically says you can destroy your profitability, right, by taking out a 5% loan effectively, so that you can then lend. You pledge the securities at par, you borrow at 5%, you then pay off the depositors who are taking the money out and going to earn 5% somewhere else, right? So what you're doing is you're creating conditions under which they don't have to realize the losses on their hold to maturity securities in order to meet that, which would be catastrophic because it's a large asset base. And instead, you basically impinge profitability as you drain deposits out of the system, right? It creates a huge cycle of zombie banks that's identical to what we saw in Japan and everything else. Now, there are people trying to figure out how to solve that, figuring out ways to create, the equivalent of a bailout that effectively allows these banks to liquefy some of these components without taking the huge losses that would in turn impair their ability to provide credit. But until that happens, the core issue is that, we've responded in a historically unusual way to this cycle of inflation. If you look back at prior periods where you have had supply-driven inflationary components, which is exactly what kicked this off. Now, we could have exacerbated it through fiscal policy. You can argue about the financing of mortgages, et cetera, although remember that really what happened is mortgage rates fell by about 50 basis points. They've now risen by about 400 basis points, so it's not at all proportional. But under those conditions, historically, what we've done is said, let's add supply to the system. This time, we decided to crush demand. I don't know.
Michael, so I mean, we've touched on this like in the United States that could have survived 25% of its total assets and withdrawal requests in light of their exposure to treasuries. So look, yeah, I mean, I agree with you, and I agree with what the guy that just dropped down earlier, I forgot his name, said.
Greg
but,
Foss.
there you go. Yeah, Foss, sorry. But the consolidation in the banking system has been happening for the last 30 years, and I think if there's any degree of certain big banks preferring specialized regional banks and either just outright acquiring them or picking them up after insolvency events like we saw with Silicon Valley Bank, do you think there's an element of concentration risk where, we end up with 4 or 5 massive mega banks and the failure of one of those banks ends up being disastrous for the economy?
Well, again, just define, you have to define disastrous. And I apologize, I have to hop off in literally 2 minutes. But disastrous is not the right phrase. Maybe I would say that it would be a far less innovative economy, or highly likely to be a far less innovative economy. It would look much more like a Canada, which candidly can't exist without the US next to it. It would look much more like a Europe, which has high components of sclerotic lending activity and, lots of, I'm trying to think about the right way to say this, pseudo innovative companies, right? Largest company in Europe is a fashion house. That's not exactly, I guess you could argue that Apple is a fashion house as well, although it has a slightly different take than, how nice the fabric is. So it's just, it's a different setup. And it's one that I personally think we would suffer if we move towards it. It would be safer and more sclerotic, right? We'd be more like old man Europe.
So, Michael, thanks for joining us, and feel free to join us anytime. We will be going for a while, so and we appreciate your input. I'm just going to play a short video from Bloomberg. It's basically the sentiment's very similar to what's been stated in this space, but just let's hear what was said.
For the most part, on point, 0.4 gain in the CPI headline. However, there is a little bit of a worry in a 0.5% gain for the CPI core on the month. That is more than the 0.4 last month and the 0.4 that was expected. So a little bit higher in the core. It doesn't really make a difference on a year-over-year basis. Year-over-year falls to 5.5%. The core does from 5.6. The headline CPI matches expectations and it comes in at 6%. Down from 6.4%. So a little progress. We'll have to check and see what that extra 1/10 comes from in the core. But it does suggest, without looking at any of this, that maybe we are not seeing the big decline in rents that everybody was looking for. Are we supposed to analyze this with the 2 years of 32 basis?
So that was it. So Matt, thanks for joining us. I appreciate it. What's your initial thoughts about the CPI report that we've received today?
Hello everybody. Since I just joined, I'm worried I'm going to be redundant, to be honest with you. I think
fine.
All right,
give us an overview on your perspective.
If we don't mind redundant. Good morning, everybody. It's no different than what I thought yesterday. I thought that what happened over the weekend wasn't going to fundamentally change the trajectory of the Fed. You saw about Supercore. And the reality is that we're not going to get inflation under control until there's a concomitant uptick in unemployment. We haven't seen it yet. Still too much wage pressure in services and whatnot. So I don't think it changes the Fed's trajectory at all. I think the market will come around to realizing that, and this slight relief rally from the crisis and from at least on target report will wane. Is just my overall prediction.
You said it was different to what you expected yesterday. I
said it's the same as what I expected. Sorry.
Okay. So this is exactly what you expected.
Yeah, it's exactly what I expected. It's the reaction I sort of expected. Relief from that it wasn't worse. But when you dig into it, it's not going to change the Fed's trajectory. Unless somebody can make an argument that just by raising 25 bips is going to send the banks over the edge, which is the immediate crisis, which I don't think is the case, then I don't see how it changes trajectory.
So you think they're gonna raise 25 bips, Matt?
I do. But there are people on this call who are much smarter experts than I am. But that's just my overall take.
Matt, why do you think that's going to happen? Why do you think they're going to raise it?
Because I think nothing's fundamentally changed, and the enemy is inflation, and their goal is to get it down to 2%. Nothing in this report thinks that it's happening fast enough. So if you look at the same facts that are on the table when they've signaled before, and what the rate trajectory would be. The whole thesis for why we wouldn't have the increase is because they broke, the system, right? And I think the system is breaking, but it's not broken, and the fundamental objective hasn't changed, which is bring inflation down. So unless somebody has a theory for what in that specific report would make them feel like inflation is now more under control than what was already assessed when we speculated they would increase, 2 more increases. I'd love to hear it, but I don't see anything.
I think the risk is that if they do pause, but inflate, say things in the financial sector sort of calm down, okay? Because we don't know what's going to happen over the next month or so. And I don't certainly want to predict, doom and gloom or whatnot. But if they do just pause at the next meeting, how difficult would it be to then just start up again with hiking rates, either whether that is even 25 bips or even in more,
Stock, you thought it was going to be above 6. What was the reason for that?
No, I said in line. What do you mean? I didn't say above 6. My guess was in line.
Oh, was yours in line? There was who was it? There was a few people who said they thought it'd be above 6.
Yeah, there were a couple people that said above 6, but I expected it to be in line. I mean, again, at that point you're just guessing. But look, Matt. What Matt said is right on point. Okay, the Federal Reserve primarily cares about price stability, and to the extent that they affect employment enough to change their tune, then they will. But we've seen the labor market statistics in the last few months, and there is no panic in labor yet, at least not enough to cause them to change points. So I agree with Matt completely. I'm not sure that I expect them to outright raise next meeting, but I don't think it's important whether they do or don't. Whether they raise 25 bits or don't raise at all, or raise 50 next meeting, that meeting will clearly be a reaction to what happened today. And, I don't think that'll change their overall path. If they don't raise next meeting, let's just say hypothetically they don't raise next meeting, I think they'll raise the meeting after.
Stock talk, just thought I'd jump in quickly. I'm not sure if you guys mentioned it already. 5 minutes ago, Moody's cut outlook on US banking system to negative, citing, quote, rapidly deteriorating operating environment. So just came out now on
what was Moody's rating on Silicon Valley Bank 10 days before it went under? But anyway.
What was Moody's rating on AIG?
Moody's is bullshit.
Yeah, I was gonna
they completely lost credibility after 08, did they?
Gone.
Yeah.
We dunked on that last night.
Are sort of lagging, like they're reactive to I mean look at Silicon Valley Bank. I think there was one analyst out of all of Wall Street that even rated them as a sell, right? So
I think they had A rating even after the FDIC came out on Feb 28th, warning about this scenario. So yeah, no credibility. Interesting to see First Republic up 50%. I mean, somebody was, I don't know if it was Douglas who was saying yesterday, that the stock price would be a proxy for deposit holders, right? Which is logical. Retail sees that number. Oh my God, and now that they're up 50%. So I think a new crisis was created, the potential zombie bank point somebody was making very intelligently, but that's a long-term issue. But I just think the crisis is abated.
I mean, it wasn't me, but since you said it was so intelligent, I'll definitely take credit for it.
Yeah, please take credit for it. It's jump ball here.
I got it.
I mean, one question I have is, and it may have been answered, I did jump off for a bit, is with the market seemingly doing well, one would assume that would have impacted Bitcoin a bit negatively, and yet Bitcoin's moved up 26,000 and it's still 26,000. So what's the reason for what do we think the reason for that is?
I think we already touched on this. People see it as an alternative to having their money in fiat. Now, the funny part about that is the vast majority of retail people that are buying it are still buying it on third-party exchanges. So it's the same problem all over again.
Not only that, but thinking about it from last night today, risk on play. I mean,
right, risk on.
Kind of it's following suit with other risk on assets, equities. So when has Bitcoin not generally been pumping with or kind of linked to, I think it was pegged to NASDAQ for a while, probably still is for the most part. So
yeah, I mean the Qs are up 2.5% today. So
there you go. So usually tech up, Bitcoin up, but the fascinating thing about Bitcoin is you have so many other narratives along with it, given its uniqueness, that it certainly is fun to talk about. And yeah, the irony of most people going to buy their Bitcoin on Coinbase There's something to be said about that. And Stock, to your point, like, how many of them are then immediately moving it on to, hey, Ledger, you're in the crowd. I'm sure you would love them to immediately move it onto that Ledger, but I doubt they're speculating through their purchases on Coinbase and immediately going into cold storage. If they were serious and had a serious position, they probably should do that.
I don't know. Don't you think, though, just not to deviate too much, that conventional wisdom, even among normies who join within 3 months, or I need to put it in cold storage? But we don't have to go deep into that. But I feel like
so you're saying normies would know to do that, or would not know to do
no. I'm saying that the learning curve has gotten shortened, like, because that's conventional wisdom that you're silly not putting it into some type of cold storage.
Oh, I would be thrilled to know that conventional wisdom is to go to cold storage if you're taking, Bitcoin and being like, I believe in this thing and got to hold it for a very long period of time. That's my stance. But I'd be elated to know that's
I just think there's a lot more awareness, because it's not that complicated to figure it out. But you're actually, conventional wisdom and the word Bitcoin don't go together necessarily.
They're right here in the audience. You can get Ledger up here and ask them to throw some stats out there of how many.
I'm biased because I'm very, very long Ledger. So
I'm in the same camp here. I'll disclose my.
I'm a bit into the weeds in the crypto space. When you go in the financial space, in the traditional space, what's the perception of crypto? Has it taken a massive hit after FTX? Or is it understood that, hey, FTX is just a bad apple? Unrelated to the decentralization of crypto. Like, what's the narrative in the?
One of the more interesting things about the space that I work in terms of the RIA I run, which is primarily millennials, is what I focus on. So very, very much in the know and apt to crypto. And what's been interesting, not just being an early adopter myself, but seeing clients and prospects come in the door. A few things. One, 5-6 years ago, I would tell you 1 in every 10 clients or prospects would have a question, exposure, or just wanting to know more about crypto. Flash forward to the last year into today, that's probably around 50 to 60%. Again, clients and prospects with either questions, exposure, or wanting to know more simply about crypto. That's absolutely insane if you ask me. Since when has there been the creation of asset class? And then over a 5-year period of time, a decent proxy of how young investors, more on the higher end, I would argue, view crypto. And I could share with you that I don't have a lot of conversations around lack of faith in investing, particularly in Bitcoin or Ethereum. They generally understand it's long term. We do advise, not on the sale or purchase of crypto, because most advisors won't touch that one. Education is fine, but we would definitely be advising, hey, if you're going to take that stance, go stick it into a cold wallet. So, to Matt's point, the learning curve, has shortened. I think depends on who you're talking to. By the way, don't discount boomers. I mean, I'm having conversations with them as well. They want to know. They have exposure, albeit sometimes not in the way you would hope so, like indirectly, and as opposed to directly owning it or self-custody and owning their own wallet. But it's been amazing to see. So just hopefully some insights into what this looks like at a retail level for, retail investors who do financial planning and have their assets managed primarily in a, beta portfolio, buy and hold, show really good discipline. It's crazy.
Just to jump in on that too. My general take, this is more, anecdotal, not necessarily empirical, but I don't know a single person I regard as sophisticated and intelligent, whose judgment I generally believe in, that has abandoned crypto, despite every calamity, losing money personally, backing a shitcoin, doing a stupid NFT project they had somebody there talked them into, like every kind of pain that everybody on this call can relate to. And yet I can't think of a single person who's like, you know what, crypto's stupid, DeFi is not going to happen, I'm walking away. Whereas I can't say the same for retail stock investing, SPAC craze, meme stocks, .com back in the day. Like, yet everyone has proved remarkably resilient, which to me is just another lagging indicator that the space will prop up. I mean, this particular rally I think is happening for a couple of reasons. One, risk on, yay, banks were saved, tremendous. Fed's not going to raise the rate. wait a second. So, I'm a little suspect. But I do think Bitcoin and ETH, to a lesser extent, acquitted themselves remarkably during this crisis, right? They didn't drop. So oddly, Bitcoin became a flight to safety. What world are we living in? But I think the bigger, more important thing is I just can't name a single person who abandoned it.
At kind of the acquisition of their first Satoshi, if you will, they became believers, and I don't mean like maximalist believers, type stuff. That's borderline cultish religion, and they're more than entitled to feel that way. I get that camp, but I'm not that. But they do become believers to a certain extent, and they know. And I would also point out, this is not their first dollar in investments. No one's saying, hey, I've finally gotten to the point where I can put risk on my capital. What's the first place I should go? And they're not going, okay, Bitcoin. It's usually when, they've built good foundations around their financial life, cash flows in control, risk management looking good. I mean that from an insurance point of view. And they get these foundational pieces in place and build themselves a decent retirement portfolio or taxable account. Then they could say, hey, tell me more about, Bitcoin. Or I'm going to take my first, my first leap into, getting some exposure here. And Matt, to your point, there has never been, it's like, hey, should we rebalance, our beta portfolio now? Yeah, now might be a good time. No conversation around, should we pare down some, Bitcoin or stuff like that? It just doesn't happen. They're pretty much fixed into it, and they have some level of belief that they want to see this thing through long term. That's bullish, if you ask me.
Thanks for joining us. Sorry, go ahead, Matt.
No, I was just
Oh shit, Ron is here.
No, to that end,
Good God, man.
in honor of Pi Day, I changed my name to my ENS name to 314.eth, and then I took one of my companies, M Pizza, and we created a discount to celebrate the inflation report, 31% off our pizzas today. You can check it in my bio. I have to plug them, but just as a case in point, I'm a grown up, and I'm that evangelical about it that you cannot shake my faith, right? So. What does that mean? I'm not sure.
Respect.
I'm not alone.
I want to, Ren, good to have you back, man.
Thanks, buddy. How's it going?
Did you trade this one? Did you trade it?
Well, I've been long Bitcoin since since Friday night when we spoke, so I haven't cut my positions.
Congratulations.
Yeah, I might actually take some profits soon. Just I think too much too quickly.
Yeah, give us your thoughts, man. I know you just covered it on your YouTube show.
Yeah, I mean, pretty much inflation is as expected. I see that the Fed, the probabilities are leaning towards a 25 basis point rate hike. I mean, that just is the Fed just going to continue to break the banking system, or are they just counting on the fact that there's not going to be a bank run? I mean, that's pretty much where it is.
Cool, man. And do you, by the way, I want to ask you about the FUD around Binance. I haven't been keeping up. What do we know, and what are the rumors on top of that? Just so I get a good idea. Last I know is that
which FUD specifically?
Shit, how much is there?
No, I mean, because Binance get attacked by the usual suspects: Forbes, the New York Times, the Washington Post.
No, that's the articles and the opinions don't mean much, but the investigations, what are they investigating? There was also one of our panelists earlier said that there's the discrepancy in the price of Bitcoin on Binance versus other platforms. Price of Bitcoin.
I mean, look, I don't know why, but I mean, it trades on a free market, right? So, I mean, Binance is a free market. Anyone can buy, anyone can sell, right? So, I mean, I don't see why there would be discrepancies, unless I missed something. Sorry, maybe you're talking about something that maybe I just missed.
It was a couple of hours ago. I don't know. I didn't see it myself, but one of the panelists was mentioning it. I think it was wasn't Da Vinci. I can't remember who it was. You know who the person is. I can't remember. There's also.
You know what I say in situations like this.
What do you say?
4, which is what CZ always says. 4. So unless CZ comes out and changes his tune, he says 4. I agree 4. Which is, CZ tweeted and he said this year is not going to. He's going to spend less time focusing on FUD, and every time something goes wrong, he just puts up 4 fingers and he says 4.
Yeah. All right. Well, that's good news.
Yeah.
There's
if you want to talk about some cool things around Bitcoin, so Bitcoin actually, by virtue of the fact that it broke I'll tell you the exact level, but Bitcoin has been trying to break the most significant trend line in its history. So there is a 200-week moving average, which is a 4-year moving average, if you think about it, right? So, and Bitcoin always remained, from a charting point of view, above the 200-week moving average until December 2018, where for one day briefly, and not even for a daily closed below it. Then during COVID, for 2 weeks, Bitcoin was under the 200-week moving average while all markets were getting obliterated. And then it broke below the 200-week moving average on the week of the 13th of June, which was the week just after the Terra Luna collapse. And it tried to break back above it in July and then again in August, and it didn't manage. And now for the first time since, it's broken above the 200-week moving average. Now, I mean, the last time it broke above the 200-week moving average was during COVID. So if you're into the charts, this is probably the most significant moving average that there is. This is probably the biggest trend line, the longest term trend line that there is. And a lot of the naysayers were saying, look, if Bitcoin breaks below the 200-week moving average, it fundamentally damages its long-term trajectory, So, I mean, it's like I'm not the biggest chartist, but this is quite a celebration on the charts. This is, if you're a naysayer, your last defense that we're not in a bull market is, well, it hasn't closed above the 200-week moving average, because all the other things have been breached. The FTX, pre-FTX levels have been breached. The 200-day moving average has been breached. The 50-day moving average, the trend line is broken. But when you look at it now, it's now broken the most significant, which is the 200-week moving average. If it closes above it by Sunday, which is the weekly close, then it will be the first time that we get a close above the 200-week moving average in a long time, since July last year.
Ran,
Would you say?
Some people. Oh, sorry, Mary. Some people may be thinking that, and I guess it's my thought as well, that is this like an artificial rise based on the circumstances of this week, and then it's just going to go back to what it was meant to be?
Well, which part of this week's circumstances would say that it's artificial? That's what you got to ask yourself. You got to ask yourself, how much of this is fundamental? How much of this is fundamental, and how much of this is artificial? So
my thought would be that basically based on what happened to Silicon Valley Bank, the concerns about it, and then people then moving to Bitcoin, afraid that might be one of the ways of securing their assets or securing their finances. That could be one reason for why it could be artificially risen, and then when the situations calm down, then they go back to fiat.
So let me ask you a question. If you're doing something wrong, I'm going to use the word wrong generally, and somebody fires and somebody fires a warning shot, what do you do after you hear the warning shot? Do you continue to do something wrong, or do you maybe change your direction and maybe do it the right way? Generally, if someone's
I get your contention. Some people would do what you said. Others would panic and then think, you know what, my panic was worthless. I'll go back to normality. And others would just not even do anything. So you do have a wide range of people.
You're right. And what I say to that is that every time that something like this happens, more and more people, it's like advertising. It's like a normal advertising campaign. Every time that the ad goes out, more and more people hear about it. And, some people hear about it and forget about it. And some people hear about it and it really resonates with them and they actually convert. Now, when you're talking about people's money, or when you're talking about people's religion, or when you're talking about people's wives, or when you're talking about people's sports teams, they seem to take that, and their kids, they seem to take those kind of things a lot more serious. Now here, you're talking about people's money. And you don't mess with a person's what I call the passion points, which is those 5 things that I just listed. When let me give you a very cool example. So my brother had money in Silicon Valley Bank. He sold his company. It's all the money that he had worked for in his whole life. He built a business. He sold the business to Gemini, and he put the money into Silicon Valley Bank. Just before the weekend, he believed that he had lost all his money. So on Friday, when he went to bed on Friday night, in his head, believed that he had lost every single cent that he had ever worked for. Now, can you imagine what he went through on the weekend? Thinking about maybe downgrading his house, maybe downgrading his car, the plans that he had for his kids and his school, and their schools materially changed over the weekend. Now, luckily, by Sunday night, there was a bailout that was announced, or a bailout that was announced. But what is he doing today? Today, he's looking for alternatives to where he can keep his money. And he's very, very, very scared of the centralized system, because he now realizes that the centralized system can fall. And so he's taking steps. Now, maybe 80% of people will just go back to the banks and just believe everything is okay because the Fed told them that everything's okay. But there will be a percentage, 10, 20%, that actually go, you know what, this is the push that I've been waiting for to go to the other side. And every time that these things happen, that's what happens. So,
and Ran, I only asked the question just to get the other side. I actually agree with you, because if you look at Silicon Valley Bank, a lot of them were tech guys. And so one would assume, or one thinks that the logical step would be that a lot of them would actually go to crypto as a safety measure at this point.
Yeah, I mean, and by the way, I don't think that everyone should now put all their money into crypto, because I think that would be, if you want to call it bad advice, I'm not here giving advice, but that would just be bad. But I think what it shows you is that like you always have a fund for a rainy day. It just shows that it's the prudent thing for anybody that has wealth to hold some of their wealth in unconfiscatable, decentralized wealth. I'm not saying that you should be as irresponsible as I am, or as all us crypto bulls are, because I think that's a scary prospect for most people. But it just goes to show that you should have a percentage of your wealth. Let me give you something a little bit more scary. Imagine that all of your cash was in Silicon Valley Bank. Just for 1 second, just imagine that all of your cash was in Silicon Valley Bank. And imagine that you came home on Friday night and you needed to go and buy groceries. And all of a sudden, you don't have access to your bank account anymore. I mean, what do you do? What do you do? And this is a real thing. I mean, I know you think, okay, it can't happen, but for people whose only cash was in Silicon Valley Bank, and I don't know how many people were in that position, because I think Silicon Valley Bank is not that kind of bank, but you may have had a weekend, a week, maybe even a month without access to your cash. I'll give you another example. And, I know you probably think it can't happen to wherever you live, but what happened in Ukraine when all of a sudden things went bad? It happened in Lebanon, it happened in Argentina, it happened in Greece. The first thing they do is they cut off the banks. It happened in Turkey. The first thing they do, they cut off the banks. So in my opinion, every time that these things happen, it's just another conversion to Bitcoin. And the thing with these conversions is that they're cumulative. So it's like, you get 10 people and you get another 2 people, that's 12 people, and then you get another 2 people, that's 14 people. It's just more and more and more people. And I think you'll agree with me that once people start using Bitcoin and they realize just how easy it is to use Bitcoin, and that you don't have to fill in any paperwork when you're at the bank, then you actually realize that it's actually an amazing experience, and then you're more comfortable to hold your wealth in Bitcoin. So I don't think that's 100% the reason for the price rise. I can break down for you what I think the reasons for the price rise are, but I do think that what happened on the weekend was an amazing advertising campaign for Bitcoin.
But Ran, without price stability in Bitcoin, you can't really purport it to be an alternative to deposit-based banking. I mean,
are you talking about price stability?
Yeah, I'm talking about regular people, like you're talking about, right? So if you're a regular person and you had all your money at Silicon Valley Bank, and the bank went under, then yeah, you're right. You didn't have access to your money for X amount of days. But if you're a regular person, you put all your money in Bitcoin, and Bitcoin goes down 15% the next week. I mean, you're not in the same situation, but it still sucks. My point is that markets decide what is a store of value, not the intention of the product or the intention of the asset, right? Like
so
gold is a store of value, not because people think it's shiny and cute. It's a store of value because for hundreds of years, it has gained cultural significance. It has gained institutional significance in a way that has made the price stable or relatively stable, so that somebody can put money into gold and say, wow, it's not down 15% on the week, right? So
may I ask you
stores of value are decided by their ability to retain value for the most recent participant. I'm not saying Bitcoin can't be one. That's not what I'm saying. I'm saying today it's not.
Two questions. Question number one, and I think, to be honest, like, again, I'm not here to shill my show because I hate people that shill their product, but go and watch my show today because I summarized it very well. But let me ask you a question. On Friday night, if the majority of your money was in Silicon Valley Bank, what other assets would have saved your ass over the weekend? I mean, you can argue, yeah, you had gold. Do you think on Saturday morning you would have gone to the cash converter and got a good fair value for your gold? You can argue that.
I mean, do you think you would have gone on Saturday morning and taken Bitcoin to the grocery store?
Yes, you can. In most grocery stores. Listen, I live in South Africa.
Bro, what are you talking about?
No, I'm saying
those grocery stores do not accept Bitcoin. I mean, that is just patently not true.
Well, I can tell you that in South Africa, the biggest retailer, which is called Pick and Pay, accepts Bitcoin. Like,
okay, my friend, but we're not talking about in the context of South Africa. We're talking about generally speaking. Okay, I don't live in South Africa, so I
I'm
believe.
asking a question. Okay, so maybe just answer my question. What asset would you have rather have been holding on Friday night?
I don't understand what you mean. Like, you're saying instead of Bitcoin or instead of my bank?
Yeah, I'm saying if your money was in Silicon Valley Bank on Friday night, and I said to you that you should have.
Where would I rather have it been?
Hold on, I said
another
to you
bank.
should have. But three other banks could have collapsed. So I'm saying,
okay. So I mean, I would have rather it been in J.P. Morgan. I mean, I don't understand your point. Your point is you're asking me, hey, if your money was at Silicon Valley Bank, where would you rather have had it?
If the banking system collapses, or there is a mass collapse of the banking system, or a bigger collapse of your banking system, what other?
Now you're talking about something else. Now you're talking about something.
I'm asking you a question. What other asset would you hold if
I'm saying you're making.
I'd like to jump in and throw out some.
You're making an intellectually dishonest point, right?
Okay.
I'd like to jump in.
Your initial argument.
Hold
on. Your initial argument was, hey, if you had your money at Silicon Valley Bank and you had it in Bitcoin instead, bravo, problem solved. I'm saying that is silly to say because
I said a percentage.
Hold on. Let me finish.
A small percentage of your portfolio. I said a small.
Well, I mean, now we're having a separate conversation. I mean, yeah. Should somebody have a small allocation of Bitcoin? Sure.
That's what I said. That's what I said. I said you should.
But again, my point is that it doesn't solve the problem you're purporting that it solves. Bitcoin is price volatile. No depositor is going to use Bitcoin as an alternative to a stable deposit. That's just not the function of it. The price of Bitcoin fluctuates by thousands of dollars weekly. I mean, what you're saying makes no sense.
Over any period, generally the price fluctuates upwards. I mean, other than very short-term blips in the Bitcoin
no.
price.
All right.
This is not the purpose
I'd like
of
to
banking.
jump in and throw out some
data. This is not the purpose of banking.
And
no one banks because they want the price to fluctuate. That's not.
I want to throw out some data.
Banking is based on.
And then we can decide whether the masses are viewing what is the flight to safety. So here's some data. Okay, when Silicon Valley Bank was basically collapsing, you had risk off. You had the S&P 500 sold off about over 3% on Thursday and Friday. Okay, you had Bitcoin sell off 10% into the Silicon Valley Bank on Thursday and Friday. Let me finish. Okay, Bitcoin sold off from 22,000 down below 20,000. So sold off to over 10% in 2 days into this bank collapse with stocks. Okay. Gold on Thursday rallied 1%. On Friday, the day of the collapse, gold rallied 2% and it rallied another 2.5% yesterday. So you saw gold. I'm just throwing out data and then people can comment. So what else did you see as a flight to safety? You saw a massive rally in treasuries. You saw the 2-year go from 5% to 1% in 3 days, which is historical type.
But you can't
moves.
hold treasuries.
I'm just talking about flight to safety and what are investors or people when things get dicey, when there's stress in the financial system, when you have a bank collapse, what did people do last week? They sold Bitcoin, they sold stocks, they bought gold, and they bought treasuries. That is just a fact. And now you see Bitcoin rallying today. And
hold on,
I'm almost done. So why is Bitcoin up sharply the last couple days? I think that personally is because of expectations of the Fed pausing, either pausing or not raising rates as much, and it's more of a pivot trade. But what you saw when things were breaking down and people had their flight to safety trade, they rushed what we've seen for decades. They rushed into treasuries, they rushed into gold, they sold risk, they sold stocks, they sold Bitcoin, they sold whatever. So that's just a fact. Those are the statistics of what happened as we saw.
Yeah, but hold on. You're mixing up one reason for the fact. You're not giving the whole story. The reason why Bitcoin sold off was not because the bank collapsed. The reason why Bitcoin sold off is because the second biggest stablecoin provider had an undisclosed amount that in Silicon Valley Bank.
That's correct.
That's an anomaly.
Yeah.
That's an anomaly.
So you're
So
saying
you
if Circle didn't have 7.5% of their assets at Silicon Valley Bank, crypto would have been stable over this period?
I'm not saying it would have been. I'm not saying it would have been stable, but I'm saying it would have definitely not collapsed as much as we can. Do you remember the fear on Friday night of people didn't know how much Circle was exposed? Most crypto holders have got the majority of their stable coins on USDC. You know, just you got to put things into perspective. This was something that directly influeed Bitcoin. But I mean, use other examples, like when the war started in Ukraine, or use things that didn't affect Bitcoin directly, and see what kind of a stable asset Bitcoin is. But also, I think again, these discussions are futile. Why are these discussions futile? A few reasons. One is Bitcoin is very young. One of you said this quite earlier. They said, gold has held this throne for hundreds of years, or 100 plus years, or whatever, hundreds of years. So Bitcoin is very much in its infancy. I mean, Bitcoin, you can argue how old it is, but let's say Bitcoin is 13 years old in terms of its life cycle. That's very early for a store of value. The general trend of Bitcoin, barring a few short periods in history, is very much up. The performance of Bitcoin really in any time frame has exceeded the performance of gold. So, I mean, you can, unless you take really small time frames in between, in general, over any meaningful time frame, Bitcoin has exceeded the value of gold. So for investors who are holding it, it would be a better store of value or an increase in value or an investment than gold. Yes, it is more volatile, but even on a risk-adjusted return, you are getting a better return on Bitcoin. The next thing is, and again, I say this to you again, because I've seen it happen to people close to me a few times this year. We have a dev team in Ukraine. We have a production team in Ukraine. The reason why our dev team and our production team in Ukraine were able to continue working was because they had crypto. As I said to you before, the question that I'll ask you guys after this weekend is, if you had your money in the banking system and your bank collapsed, what asset would you have liked to be holding to get you through the period until the Fed bailout, which coincidentally this time round was only 3 days? It could have taken 3 weeks. It could have taken 3 months.
Yeah, Rand, anyone can solve the problem that you're purporting by having their money at different banks. Again, like, there are reasons to be bullish on Bitcoin, but the problem that you're identifying that it solves is just frankly silly. Like, you're telling me that if somebody had money at a failed bank, that they should have rather had their money in Bitcoin. That wouldn't have solved the problem.
Do you mind if I jump in and
percentage of their portfolio?
Can I jump in and give the perspective?
Solve the problem of them needing to go to the grocery store.
You mind if I jump in and give the idea for a perspective from a participant who's trying to de-risk? Thanks, Mario. So Friday was really interesting, and this discussion is really interesting. So, we've been a Silicon Valley Bank client, for many years, for 8+ years, and suddenly on Friday, our main bank, obviously went bust. We also hold a lot of crypto positions, and we have trading parties that allow us to on-ramp and off-ramp to crypto, from crypto to fiat. But suddenly on Friday, we had the inability to off-ramp into the traditional financial system with our crypto assets. So of course, Friday, as people have noted, I think USDC at that time was touching 89 cents. And we were looking to de-risk, right? I mean, to the points that are being made, we would have rather been in our JP Morgan account. But of course, our trading counterparties, and they're ready to do our trades for us. And then they said, oh, we noticed that your main bank, Silicon Valley Bank, is no longer, around. And so we gave them our JP Morgan information. We said, well, here's our JP Morgan account. We've been a longtime holder of that account. And they said, well, it's under a different corporate entity because it's under, a subsidiary of ours, and it's just a wholly owned corporate subsidiary. But we literally had no choice. We had no way on Friday night to, and at the time we couldn't get into stable coins because we didn't know which stable coins were going to be okay. And we even went to the point where we said, well, let's go trade on DEXs to try to synthetically create a stable coin by basically doing a cross 1x inverse, short, right? So go long, 1 BTC and go cross 1x inverse short 1 BTC. But the problem with that trade is that the interest in that was so high from people. This is Friday night, like Friday midnight US time. The interest from folks who were just panicking was so high that effectively the APY to hold that quote stable coin, the synthetic stable coin, hit around 20%, right? So we're sitting here with effectively no ways to off ramp into this flight to safety, right? I mean, if I could have hold treasuries Friday night, that would have been great. But we have all this crypto assets, and there's just no way to convert it. And so I think that's one thing to think about. And part of the pop is because of the amount of short interest, right? People were just creating the synthetic stable coin. And then once things stabilize, USDC is okay, then they can go back to those kind of de-risked quote assets. So that might explain some of it, just because the short interest was incredible, just to be able to create stability, or at least synthetic stability in the crypto markets. So that's just as a market participant. I mean, as somebody who's trying to de-risk, TradFi failed us on Friday night, but crypto 24/7 global highly liquid markets, was allowed us to trade and allow us to create positions that try to achieve as much stability as we could. And frankly, after looking at things, we're like, well, do we create the synthetic stablecoin, pay 20% APY? Do we go to these stablecoins that might go down even further or have existential risk like USDC? Or do we try to, or do we go to something else? And actually, to be frank, BTC and ETH seemed like the safest thing. No counterparty risk. No need to go into the balance sheets of these stablecoins and look at their reserves. And the quality of the reserves. And I mean, it was kind of incredible. My faith in ETH grew. Mm-hmm.
Wasn't it amazing that you actually had the possibility of doing this by yourself at 12 o'clock on a Friday night? Because I can tell you that the people that I know that had their money in the banking system, their hands were tied. They had no way of creating synthetic long and short positions to hedge themselves. They had to wait for the bank to maybe open on Monday. And we're lucky that the banks actually did open on Monday because the Fed stepped in. But remember that Fed bailouts and situations don't always resolve themselves in the span of a weekend. And that if your situation doesn't resolve in the span of a weekend, you're screwed. And I've seen it multiple times. And again, I say, like, I've experienced this Sorry, my battery died. Can you guys hear me?
Yeah.
Yeah, we can hear you now.
Yeah. So I've experienced this multiple times. And the last time that I experienced this was with our developers in the Ukraine, where, as I say, our business wouldn't have been able to continue to run in the Ukraine if we didn't have access to crypto.
I completely agree. And these trading counterparties who, I still, I respect and I understand why they couldn't trade with us, but we've been trading with them for years, at size, and suddenly on the day we needed them the most, we couldn't do it. But thank goodness that there was a liquid global market that we could participate in, on a weekend to try to de-risk. It was kind of incredible. My faith in all probability only grew.
In all probability, anything that you needed the money for, and I don't know what your business does, but in all probability, 80% of what you would have needed money for in the short term, you probably could have somehow paid in crypto. Like, I don't know if it's your staff, maybe even your landlord, somehow you could have maybe lodged a deposit with them or something if you absolutely needed to. You know what I mean? Whereas if your money was in the bank, you had zero access to it. People were buying bank deposits on the weekend for 50 and 60 cents. And companies sold some bank deposits for 50 and 60 cents over the weekend. And on Monday morning, so it's like, yeah, I'm not saying be irresponsible and have all your money in crypto. I'm just saying, I think it is prudent, given for people who have assets, to have some kind of asset in Bitcoin. I'm not saying ETH. I'm saying Bitcoin, just so that if shit goes wrong, and we've realized now that shit can go wrong in many different ways, that you have some kind of money that you can control and you can trade with. And maybe if you're living in the US, where I hear a lot of the accents here are living, and you're a rich country and you have, a government that pretty much looks after you regardless of what happens. When they crash the banks, they fix the banks. When they do lockdowns, they give you guys stimulus. Maybe in the US, maybe it's slightly less of a need, but there is a need. But in any other country in the world, I think it would be negligent not to have some kind of money that you can move around with and be disconnected from the banking system. Specifically in a time like this, where
thanks. Tiger, thanks. You're a crypto guy as well. I mean, one of the main concerns what people have when it comes to crypto, I think, is the fact that it fluctuates so much. Now, obviously, it's down below 26 now. It's gone down. It's down by $50. It's down to 25,950. But the point is, obviously, that's a minor fluctuation. But the main concern is fluctuation. Like, an average person doesn't want to risk their money and the fluctuation that occurs with it. Is that a fair concern?
There's a thing called risk-adjusted return. I don't know. I mean, the concept is that you look at the return that you make over a certain period of time, and you look at it relative to the risk. And when you look at Bitcoin's risk-adjusted return over good time periods, I don't have the chart in front of me because I'm just leaving the office, but even on a risk-adjusted return, Bitcoin has a superior return to most assets that most people hold. So I think, I like to look at facts, and I like to look at fundamentals and statistics, and not just to talk about emotion, because, in this industry, there's a lot of emotion. But even on a risk-adjusted return, when you look at the risk-adjusted returns of Bitcoin fares, depends on which time period, but on most time periods, Bitcoin fares king in all of those. So, it's you got to make rational investment decisions based on data.
No, I get your point, and I actually can't disagree with it. But what I'm saying is, when you're looking at it from an average person, in terms of using Bitcoin, because you're almost. I know you're saying that you weren't, but you're almost giving it as a true alternative. And I'm saying the fluctuation on it is so volatile. That would be a concern. So for a person who, I understand from a long term, you're taking the risk and so on and so forth, but people don't want to take risks. So the issue there is, what would be the answer to those people who actually don't want to take a risk and are concerned about the volatility of Bitcoin and crypto in general? Not Tiger, do you want to answer that?
Oh, hey guys, I'm sorry. I was a little I'm in the middle of work, but I was just listening. I had another question, but I'll let you guys finish this topic of conversation if it's more interesting to everyone. But I guess this is kind of relevant actually, so I will ask it. So to the crypto guys in here, so like I'm learning that Signature Bank might have actually been solvent, and I'm looking at the reasonings for the shutdown, and I did make a post about it, and it implies that they're involved in a nefarious activity in regards to Signet. So do you believe that the bank was shut down as a result of the potential legal liabilities that surround Signet, or the potential risks that the depositors or the crypto depositors hold at that?
The official reason for the bank shutdown was what they called, in inverted commas, systemic risk. Systemic risk is basically a wide range of risks that no one can put their finger on. And what they say, it's shut down for synthetic risk. And in this case, it was around liquidity risks. Allegedly.
Well, I know what systemic risk is, but if you look at the New York DFS, they actually highlight the reasons, and I can read them out to you. So one has violated any law, is conducting its business in an unauthorized or unsafe manner, is an unsound or unsafe transact its business, cannot with safety and expediency continue business, has an impairment of its capital. I mean, I have it posted there, and this is very clear. So it seems that they've violated New York banking laws in some manner, right? I think they abused their crypto license or their license to operate a crypto related business in the state of New York. So just curious if anyone had any
I mean, I must say I haven't heard that any direct accusations of any direct violations of law, and I'm sure that they will come out in time because
Iran, you broke up.
The government wants.
Yeah, I mean,
sorry, someone a call came in saying that's exactly what the government wants. We haven't heard that yet, but we do know that there's this thing called Operation Choke Point, where they're trying to choke the on-ramps and off-ramps to crypto. We know that that's not. I mean, we know this. This has been something that we've been speaking about.
I mean, hold on. What do you mean? Yeah, we know this, or we speculate this?
We speculate this. It's becoming pretty evident that.
Who came up with the name Operation Choke Point? Never heard of that.
You can go to Wikipedia. It's actually a term that is used for all industries that the government is trying to choke, and it's not only crypto. It's drugs, it's illegal drugs, marijuana, etc. It's pornography, and now crypto is part of this industry now. So it's part of this what they call Operation Choke Point. It is when the government tries to choke the supply of oxygen or money, in this case, to the industry. And, you know, it does this through crazy regulation. It does this through enforcement actions. It does this through making it unviable for the banks or the financial institutions to actually be dealing with it. Now, when you look at the amount of scrutiny that a bank like Signature Bank was getting around its crypto deposits, no wonder they made a statement that they were starting to reduce their exposure to crypto a while back. They stopped taking many deposits, and they said that, you know, they issued through Binance that they were only going to do deposits over $100,000 because obviously the amount of work and KYC that they had to do was just too much for the $1,000 and $2,000 and $5,000 deposits. So we know that since FTX gave the government a great excuse to clamp down on crypto activity, and that's what they've been doing. And if you look at Jesse Powell's tweet the other day, he literally laid out all the crypto-friendly banks and he marked them with crosses where they're starting to disappear. We lost 3 of them in 1 week. So it's no big secret. It's no big secret that the government's trying to, or allegedly trying to choke the inflow of money into crypto. Not a big secret.
And Ran,
Operation Choke Point started. Operation Choke Point started in 2013 under the Obama DOJ.
Sorry, I don't know who's talking. But Ran, isn't that another point of concern again? So that's another thing when I spoke to people is a concern why people don't want to go into crypto for that reason, because regulation could make it problematic.
You're right.
Well, I think it has a different implication in that it's all about kind of, you know, U.S. regulatory policy, which is obviously big. I mean, as an American, you know, largest country in the world, but it kind of almost pushes innovation elsewhere. But I mean, going back to Choke Point, so the original Operation Choke Point was under the Obama DOJ, you know, in 2013, and it was originally designed to sort of use extrajudicial measures effectively to kind of sideline, you know, kind of things like firearms manufacturers and some other folks in sort of, you know, I guess somewhat shady, nefarious industries. So I don't think anyone complained about that. The problem is now, 10 years later, you know, current administration and really just the government overall is sort of using it as a way to you know, deplatform things that they see as, you know, deplatform them from banks, you know, even just organizations, you know, like various tech platforms, but certainly crypto is right in the crosshairs of this. So, I mean, it's a real thing. I mean, it's interesting that's taking kind of this 10-year gestation where you go from, you know, kind of trying to target things that I think very few people would have issues with deplatforming 10 years ago to now trying to deplatform an entire industry and make it very hard for people to access banks. So I think there really is a concern that, you know, large banks, or basically the only banks that were friendly to our industry, are not sort of solvent anymore, around anymore.
Non-existent. You know, there is the last I remember, Joe Biden came out with the executive order to regulate crypto in such a way that it keeps the US at the forefront of innovation, etc. I don't know if you remember that big executive order. And many people were tasked with this. One of the people that wasn't tasked with it was Gary Gensler. And, you know, the SEC is now also on the warpath against crypto. So from a regulatory point of view and a legal point of view, there is a war against crypto because I think it's a logical war as well. You think about it like this. Crypto gives anybody the ability to move millions and hundreds of millions and billions of dollars around without any kind of intervention. You can move money for any purpose across to anywhere in the world without government intervention. I think it's naive to think that that's not going to be regulated, very, very, very highly regulated and controlled by governments, because there's a tax element to it, there's a criminal element to it. In many countries, there's what they call foreign exchange controls, where they try and keep the local currency inside the country. And so I think it would be naive to think that the ability to move large amounts of money around at the touch of a mobile phone is not going to be highly regulated and eventually highly policed. I don't believe for 1 second that there are going to be two financial systems running. One financial system which is highly regulated by the government, which is the current traditional one, which doesn't allow you to do many of the things that you want to do because of regulation and because of intervention, and then one where you can just do whatever the hell you want, whenever the hell you want, with whoever the hell you want. I don't think that that's logical, and I think regulation always lags behind innovation. And I think that now the regulation is going to catch up to the innovation, and I think that that's going to mean a whole lot of things that we don't like. I think it might even go into things like non-custodial wallets having to be labeled with certain exceptions. I wouldn't be surprised if eventually that's where we land up. And to be honest, as someone, I mean, looking at it from the regulator's point of view, what option do they have to just allow anybody to move millions of dollars around from one country to another for any reason without some kind of financial control? Doesn't really make sense in the world we live in.
But the interesting thing about it is let's say it's the U.S.'s loss will be the rest of the world's gain, right? Singapore's gain or Switzerland's gain in terms of just pure innovation. Going back to what you're talking about with crypto innovation. I mean, it's becoming harder and harder to be an operational crypto company in the United States. I mean, we're lucky here that we still have some of the most innovative and some of the most innovative crypto companies still are mostly in California or New York. Maybe a few in Miami. But it's really disheartening to see, because I think it's going to really push innovation elsewhere, because the regulatory regime is clearly not helpful. And if you're a crypto startup, it's just really hard to get banked. If you're a de novo crypto startup, it's hard to get banked, let alone create a new bank that will be friendly to this ecosystem.
I think that you're right. I think it's very sad that the US has taken this approach, but I also think that we really believe that crypto is the next big thing. But I think when regulators look at it from a global point of view, like when the Biden administration or any government administration looks at it from a global point of view, they're looking at it in the context of AI and the context of renewable energies and stuff like that. And they're saying, look, this is like, for us, crypto, or for me, certainly crypto is the be all and end all. It's my industry. It's what I live every single day. But I don't think that the regulators look at this and go, wow, if we don't keep this crypto thing, our country's going to go down in ruins. I think if the US leads in AI, and if the US leads in renewable energy, which they clearly are going to do with Elon Musk and stuff like that, like I don't think they see this. The regulators see this as like the one industry that if they don't have in their country, I think a lot of smaller jurisdictions with smaller economies see this as a way to attract some of the smartest minds in the world and to bring in incremental revenue and tax revenue and stuff like that. But I don't think that many regulators, specifically in the US, see this as like the one and only industry that if they don't have first place in this industry, that their whole country is gonna and their whole economy is gonna be in ruins. I don't think regulators see it like we do.
Well, I slightly differ with you. Okay, go for it.
No, so it was the same question, you see, because I just feel like it's not fully been answered, and it's actually the main. When I speak to regular people, that's the main thing that that's the main concern they have. That what not the main one of the concerns they have. They say they feel like if the US makes very stringent puts in very stringent regulation, you may have a scenario where the value of Bitcoin drops. Now I know what you're saying. Guess what? They can go elsewhere, but this concern, how? I mean, first of all, one, how would you alleviate that concern? And two, how by going elsewhere does it solve the issue?
Yeah, I didn't hear the whole question. Sorry, my phone cut. So I didn't hear the whole question. I don't know if you just want to repeat it. Sorry, man. I'm driving.
No. So basically, the main concern a normal person has is if I'm going to go into Bitcoin or move my money to crypto, that first of all, the regulations in America seem like they're not going to be friendly. If not, they're going to get worse. And so that may first of all make it very difficult to deal with crypto in the US, or more than that, really. It'll drop the value of the crypto. And the second point is, which you guys mentioned, that, well, guess what? They can go elsewhere. How does going elsewhere kind of alleviate that problem?
I mean, if you're a developer and you really believe that crypto is the future, and eventually you think maybe the regulations now aren't friendly, but maybe in 10 years they will be friendly, which is actually when this industry really comes to its own. Then you'll do what a lot of people are doing, and like they're going to Dubai, they're going to Singapore, they're going to all these crypto friendly jurisdictions where they can operate. I've got to be honest. Like, I used to live in the United States, and the reason why I left the United States was because United States wasn't crypto friendly, and I didn't feel like being in a country where I couldn't do what I needed to do, and I had to worry about regulation. And so I left. So the US lost me. I'm living in Cape Town. Here I can do more or less what I want to do without the strongest of regulation, because because it's a little bit more open here. I mean, let's look at Mario. Mario's not living in the United States either. He had the option to go live in the United States, and I think part of the reason why he's not there is because he has a lot of exposure to crypto. So I mean, you are seeing this actually happen.
I think the other interesting thing is, like, some of the best companies, I'm not talking about the Coinbases of the world that have been working with regulators and have effectively gotten punished for doing so. But even like, let's take DYDX, right? A decentralized exchange that is being built out in New York mostly. What's fast with an American team, but what's fascinating about it is that Americans can't trade on DYDX, right? These DEXs that are being built by American minds are not being able to use by America. But guess what? DYDX has incredible volumes globally across the world, right? If you just look at some of the flows, and in particular this weekend. So that's kind of interesting. But the other question about where is also an important one, right? Because it's like, well, if not the U.S., then where, right? Because U.S. has so many structural advantages, right? We have, we could list things off, but like, look at Binance. So Binance, kind of was trying to build more in Singapore, for example, which is traditionally seen as fairly crypto friendly. But they kind of this was kind of last year, they waffled and decided to kind of double down on Dubai and actually France, which was an interesting choice, right? And sort of commit less to Singapore. So these things kind of evolve. Thailand, right? Thailand's SEC is looking into, was friendly in the beginning, but over the last year or so has become a lot less friendly towards crypto. So I guess the question is, well, I mean, you got other smaller nations like El Salvador and things like that. But if you're a crypto developer, you're like, if not the US, where, right? And still, there are some great decentralized protocols and projects being developed out of the US. So I certainly don't think we should call the US out. But the other thing about the US is, I don't think that the US would be satisfied with, having the center of finance, which I don't think we can argue the center of finance is, the US is not only the biggest economy in the world, we have, the greatest financial centers in the world. I mean, there are, of course, other great ones in the world as well.
Guys, I'm going to jump. I'm going to jump. Just excuse me. I'm going to jump.
So thanks for that, Ran. I appreciate it. Jeff, thank you so much for joining us. We've got the CPI result, and if you can give us your initial thoughts about it, that'd be brilliant.
Yeah, I've been super swamped in all the issues with the SVB situation, but it certainly looks like notable deceleration, or at least something the Fed would be hoping for. I was enjoying the last conversation, and sort of like for the first time in 5 or 6 days, not having to think about a potential bank run. So I think, I was saying this morning on Twitter that as mad as people were in some instances about the mechanics of what happened over the last few days and what the FDIC did, the fact that we're sort of talking about crypto again and talking about the inflation report and sort of getting back to more normal political discourse is, I think, already a good sign for the administration that people might say they're mad, but as long as there isn't a bank run, they're quite happy.
And what I mean, you're right in terms of that being contained, but do you think that's been something that's been contained in the short term and not in the long term, or what's your thoughts?
I think my sense from people inside the administration is that it's really too soon to say, but that they're really sort of cautiously optimistic that the volatility is way down. There are some indicators of the regional banks that look a lot healthier today. I think obviously there's still some concerns about the 2-year and the inverted yield curve, but they seem to be, people here probably tracking this more closely than I am, but seem to be in a good place. I wanted to come back on just because I know we closed the loop from a discussion we had yesterday. We discussed yesterday about how, the president's body language during the address announcing this information seemed a little off. And after that conversation, that we went out and reported, talked to people inside and outside the administration, and learned a little bit about how Biden had some reservations, some skepticism about the initial plan, sort of worried about doing anything that could be perceived as or characterized as a bailout. But as the extent of the contagion appeared clear at other banks, felt that they had to do something. So thanks for the opportunity to speak, today and yesterday, and have appreciated being on.
So in terms of Biden, do you think, so we understand the reasoning for it, because he was afraid that he's going to be considered a bailout as per 2008. At the same time, he didn't want to be stood not doing anything because he would have been blamed in that regard as well. But then I guess he's still being blamed for basically essentially saving the depositors. So do you think that he made the right move based on the situation that he was in?
Yeah, not really for me to say whether it was the right or wrong move. I mean, I do think if you're Treasury Secretary Yellen right now, you're feeling quite good about the decision. There was sort of this unfalsifiable question of what would have happened had they not backstopped all uninsured deposits. But the fact that the volatility appears to be calming in some key metrics, we'll never know what would have happened if they had never done that. But it's an indication, I think, that they've restored some confidence, some stability to the system. I think the thing we're going to be looking for now is trying to understand sort of what was going on behind the scenes in terms of lobbying from Silicon Valley.
Sorry, Jeff, you seem to be breaking up. I mean, while Jeff gets back on,
did
Douglas,
Jeff drop out? Did he?
Yeah, I think he's dropped out. Yeah.
What did he say? I got a call and I missed it. What did he say, essentially?
It was interesting because he was basically saying that he'd spoken to people within the Biden administration about, the decision, or the decision making process, and what the things that Biden was concerned about, and so on and so forth.
And then he dropped out.
Yeah.
Jeff, don't do that to us. Right, he should be back shortly. I'll DM him. Let me send him a quick DM. But it's interesting. I'm just looking at the what is Stock Talk? Are you there? I'm looking at the Bitcoin price. Yeah, man. How the market's doing? Bitcoin is stabilizing. It's at just under 26K. Picked up again in the last. Oh no, it didn't pick up. Let me see. Oh yeah, it's been stabilizing at just under 26K. What are the markets looking on your end?
Yeah, the equity market's just steady grind up today. We have a pretty big test for the S&P 500 here at 393.30, and so there's a bit of resistance there, but pretty steady grind up in most indexes today. The Qs, testing that 298 spot, IWM up 3%. So Yeah, not much has changed on the equity market side. Bit of a continued rally in some of these gold stocks today. They had a really strong last 3 sessions. Not as strong here today. The rally that we saw in regional banks is getting a bit of a fade. FRC was up, I think, 70% at the peak in pre-market. Still up big. It's up about 48% here. Pac West as well, up big, 57%. But the other names that rallied in unison with that jump in some of these regional bank names are fading. Biggest relative weakness candidate amongst the banks is Credit Suisse. Credit Suisse has had a lot of bad news over the last few months, but they delayed their annual report a few weeks ago, and then came in and kind of pounded the table on their confidence in the business this morning. I'm guessing the market didn't really buy it. That stock's down about 3%. The rest of the banks are green, but yeah, not too much has changed since we touched on it earlier.
Cool, man. I'm just looking at the. I just want to kind of put things into perspective while waiting for Jeff's audio to work again. I'll read this out from Reuters. The FDIC made a record withdrawal of $40 billion on Friday to save Silicon Valley Bank. So that's based on government data. The FDIC withdrawal from the Treasury General account was many times larger than any previous largest withdrawals, according to data. Combined with about $13 billion of other federal agency withdrawals on Friday, that left Treasury with just over $208 billion. Let me close this up, in operating funds at the Treasury, at the TGA, which is held at the Federal Reserve. That was down by more than $100 billion from Wednesday's balance, reported by the Fed. How much more can the FDIC do? Because they're running out of ammunition, stock talk.
I mean, look, the FDIC's real purpose is maintaining trust in the American banking system and maintaining confidence in the American banking system. When we touched about the risk to banks overall yesterday and the day before, a lot of what we discussed was the fact that, look, every bank in the United States is, in theory, insolvent if they have to realize the losses on their treasury, right? So, when we talk about the FDIC, a lot of people want to point to the FDIC's balance sheet and make the conclusion that, look, the FDIC just simply doesn't have enough cash to fully insure the deposits at every bank in America. That's obvious. I mean, we already knew that. But the real takeaway to have is that the FDIC is an extension, essentially, of the United States Treasury. And so, in a hypothetical scenario where more banks failed, can the FDIC continue to fully insure all deposits everywhere? Obviously not. But the decision they made to do that here was, again, more a decision about sentiment than it was about numbers. In the financial space, we often tend to get hung up on the numbers. Everyone wants to talk about the potential losses on long-term duration treasuries. Everyone wants to talk about the balance sheet of the FDIC, how liquid it is, et cetera, et cetera, et cetera. That has little to do with the decision-making in moments like this. I've made this point before, but I'll repeat it. Back in 1991, when the Bank of New England went under, Powell, who's now the chair of the Federal Reserve, was working with the FDIC back then. And he said, word for word, we were faced with a decision. The decision was either fully insure all deposits that were lost or risk a bank run on the entire American financial system. And he said the choice was obvious. Without a single dissent, they chose to fully insure those deposits. And so what that does is it corrals sentiment and panic, because in the case where the FDIC would have come out yesterday or the day before and said, no, we'll only insure up to $250K, and everyone else who had more than that loses their money, what's going to happen? You're going to see a broader run on banks. And so these decisions are more, in my view, about maintaining sentiment, about maintaining confidence in American banking, as opposed to the balance sheet of the FDIC. I'm not concerned about the FDIC running out of money. And I think the people that are pointing to the FDIC's balance sheet saying it's unsustainable just frankly don't know what they're talking about. That's not the point here. The FDIC is backed by the United States Treasury. The United States Treasury is not running out of money. And so I think that's the simplest way to look at it.
Okay, so if it starts running out of money, the Treasury could fill those coffers
Yeah,
back up if we ever get to that
processes
stage.
in place to refund the balance sheet of the FDIC. And if we get into a situation where 10 more banks fail and the FDIC is pumping out, hundreds of billions of dollars in that case, then I would imagine there will be other backstops in place. But I don't think we're ever going to get to that point. Typically when banks start failing, the government acts very quickly, like they did, in this case. And they have the ability to backstop those failures like they did. And that tends to improve sentiment. I mean, look at the rally we're seeing in banks today, right? I mean, some of the names that were down yesterday up 50 to 60% today. So that shows you that the power of a federal backstop. And again, I want to be clear. I'm not an advocate for the government dumping money into everything. In fact, it's quite the opposite. I tend to be pretty conservative financially. However, in this case, it is not about the numbers. It's not about the injection of money. It is about public sentiment and the knowledge that if the public loses confidence in the American banking system, then the notion of commercial banking ceases to exist. The notion of commercial banking depends on the idea that a regular person will go to a bank, give them $100,000, not expect a return, and operate under the belief that that money is protected. That's what the entire banking system relies on. So the second that that notion gets dispelled, you risk a bank run. And the FDIC knows that, the Fed knows that, the Treasury knows that. And so these decisions are less about the numbers and they're far more about public sentiment, in my view. And it's not a fact.
Does that so which other countries have the same fractional banking system as the US? Is it most of Western Europe?
I mean, in entirety, the world's banking system is a fractional reserve banking system. There's no.
But to what level? To what levels though? Because the U.S. is at how much reserves they need to have? Like 6-8% or something.
I don't know what the capital ratio requirements are at international banks. So I couldn't accurately comment on that. If there's a speaker in the audience that does know what the capital ratios look like at European banks versus U.S. banks, I'd be happy to hear that. I can't comment on it personally, but. There's a lot of clamoring for things like the United States banks doubling their capital ratios or doubling their reserve requirements. And I think that, when we're talking about that, we have to slow down and ask ourselves, how will that impact general liquidity in the financial system? How will that impact ease of access to loans, right? All of these things are factors that function off the ability of a bank to dispense money. And the more we increase, sure, does it make the system safer? Yeah. But if we're trending to a system in which every bank has to keep every dollar that they have available, you've destroyed banking. There is no banking industry if a bank, like, for example, if I go to a bank tomorrow and give them $1 million, and the requirement is that that bank keep that $1 million in a back room somewhere, why would they do that? Why would they offer that service to me? Right? So you destroy the industry of commercial banking the second you say a bank should have every dollar available for every person that banks with them. They can't exist in that case. There's no way for them to make money.
I'm just going to look at that's actually very curious learning this stuff. I'm trying to see the capital requirements over the years, how it's changed, because it kept going down and down and down.
They changed
over the last few
dramatically.
decades.
The Basel Accords are what they changed dramatically. So people can look up, Basel 1, Basel 2, Basel 3, and their effect on capital requirements if they're interested on it. But there's plenty of free information on the internet that's available for it. There's an article on the Bank of International Settlements website, BIS.org. Anyone in the audience can go look that up. Look up Basel 3, and you'll find out about the Basel Committee and all the developments they had post 2008 with the Banking Supervision Committee to try to prevent this from happening. So capital requirements went up, reserve requirements went up following 2008, the way that they should have. I'm not knocking the fact that they did, and maybe they need to go up a little bit more. But I would emphasize caution when we start making statements like, "Hey, every bank should double their reserve requirements, or every bank should double the tier 1 capital ratios." That is a bit removed from the nuance that's involved in doing that, because again, the ability of banks to dispense funds is a really critical part of the global economy, especially in the United States, where a lot of these specialized regional banks are part of the reason that everything is invented in the United States. I mean, there's a reason meaningful innovations come from the United States, because we have a system that provides specialized capital resources to companies that need it, that in other banking environments, those companies would not be good loan prospects, right? Like the United States is one of the only places in the world where a tech company that is burning $20 million a quarter and hasn't been profitable for 5 years can raise money. Now, the second part of that equation becomes, are we allowing the existence of too many zombie companies? Are we allowing the existence of too many unproductive companies? Now, that's a deeper conceptual question, and I think that that's worth debating. But what I will say is there are trade-offs, right? The ability of the United States to fund speculation and fund technology and fund innovation is the reason why we lead the world in all of those things. If we made capital severely more difficult to access, it's similar to what Michael Green said earlier when he was in here. You turn the United States into a less innovative economy, similar to Canada or Europe. And, the question becomes, do people want that to happen? I certainly don't. I think that the ability of the United States to finance these things, or the ability of those companies to seek financing in the United States, is a very, very important part of the American economy. But, I know that there's a lot of people that disagree with me on that. That's just my opinion.
I'm very curious. Yeah, if anyone disagrees, I want you to jump in just in a bit. Stock Talk, the current populism is spreading across the world. I'm worried that narrative and politicians' desire to get votes outweighs the importance of safeguarding the banking system, because it's getting more and more unpopular. It's been, and especially since 2008, and we saw the pushback in the last few days over the bailout of Silicon Valley Bank. Does that concern you at all?
What specifically about that? You're saying like the incompatibility of the
because of the political environment and the populism spreading, they don't save a bank when they need to, jeopardizing the system.
I mean, but I don't think anyone's clamoring them to save shareholders of the bank, right? Like, even when you look at this incidence and you look at, for example, let's take the All In podcast guys as an example, Jason Calacanis and all those guys that were, that had money there and were rightfully upset. They weren't clamoring for a bailout of shareholders of the bank. They were clamoring for all deposits to be fully insured, regardless of the FDIC limit. Those are two different things, right? Bailing out the bank implies saving shareholders to some degree.
No, but the term has been used loosely. They're calling this a bailout, even though now it's only depositors.
I don't consider this, I consider
we don't.
this,
but the average Joe is. They're just conflating the two, and that's what
sure
worries
and then
me. They're calling this a bailout.
The question becomes, look, okay, when we talk about bailouts, where people push back is they say, look, in a capitalistic economy, when you take risk and that risk doesn't pan out, you should be punished for it. I agree with that completely, which is why I don't believe that in the cases of bank failures, shareholders should be bailed out. However, if you believe that, you should ask yourself the question, are depositors taking risk, right? This is the fundamental question. If you believe that by putting money in a bank, depositors are taking implicit risk, then sure, maybe we shouldn't fully insure them. I do not believe that that's the way banking should work. I do not believe that we should essentially imply to the American people that when you put your money at a bank, you are taking risk. And if that bank goes under, your money is gone. That's a dangerous, dangerous notion to put out there, because all of a sudden you've removed the incentive to bank entirely. Why? If you told somebody, hey, if you take your $1 million and go put it at JP Morgan, if JP Morgan goes under, you lose your $1 million, you're basically turning depositors into investors. And I think that's a very slippery slope, and it's dangerous. So, what I would say to those people who consider this a bailout is, do you believe depositors should have implicit risk when they're putting money in a bank? I don't believe so. Now, do I believe investors should be exposed to that risk? Yes. So if you're an investor in Silicon Valley Bank, no, you shouldn't be refunded. But if you're a depositor again, it becomes a more nuanced issue because it's not a numbers game. It's not about the FDIC having the money to do this. It's about the implication of not doing it.
I don't think it's an issue.
What if there's a scenario where your stock? What if there's a scenario where your deposit is linked to your credit, or your deposit is linked to like various other benefits you get from the bank?
I mean, be more specific.
Of course I can, yeah. So basically for Silicon Valley, we are getting information that first of all, the reason why a lot of them were depositors in the bank or deposit their money was because they were getting lines of credit from the bank. There was also benefits in terms of networking. There was also benefits in terms of having a close relationship with the bankers, with the management, with the shareholders or wherever it may be. And so because of all of that was basically in a pot, and it was all linked, and you weren't able to just separate it quite easily. Do you think it's as simple as saying it doesn't matter your deposit, your deposit's going to be?
Yeah, I mean, I think my short answer to that would be I don't think we can afford to make that distinction. I think that a depositor who is putting money at a bank should not be implicit risk, and I think instilling that notion in people is, again, as I said, very, very dangerous. So are there going to be exceptions?
Even if he's deposited because he wants to take the risk, because the bank essentially has taken the risk by
credit doesn't matter though. Credit, you're not going to get paid back credit. If you put, listen, I've been doing finances for a long time, man. If you put $250,000 into a bank account, it's obviously insured. But if you put $250,000 into a bank account and take a $250,000 loan against it, that's not insured. That's the bank giving you money and you're taking a risk there. That would be your risk at that point. Yes. Now, listen, if you have the $250,000 in cash and a $250,000 loan, then that's where there's a very gray area, because it's, well, is the depositor still insured, even though we can, they owe us $250,000? Do we give them their $250,000 back, or do we take it because they had a $250,000 credit line? And that's why they've been using the word backstop and not bailout. Bailout is they didn't get bailed out. If they got bailed out, the stock would be trading right now.
So the bullet, just to add an extra layer to your question, imagine a scenario where you wanted a credit line. So let's say you wanted a credit line from the bank for $100,000, let's say, and to get that credit line, you agreed to put in, I don't know, $50,000 or $150,000 into the bank, right? Now, the only reason you did that is because SVB was the only bank willing to give you the credit line, because a Bank of America, or for example,
that's the risk
Morgan,
you take. That's a risk. That's considered a 100% risk.
Yeah. So that's what I'm saying. So, but then they deposit. The only reason they use that bank account for the deposit.
But why does the reason they deposited matter? The point is, Suleiman,
because it's linked.
No, that doesn't matter. That doesn't make a difference. The point is that the credit facilities are not guaranteed by the FDIC. They shouldn't be. Neither should the shareholders, right?
So no, I get that. That's easy.
No, he's saying if you get fugazi'd into putting money in the bank account because the specific bank said, hey, if you put $150,000 cash in this account, we'll give you a $100,000 loan. That is a risk you are taking, and that is your risk. And if it plummets under, that is on you. That's a risk. Now, if you're putting straight cash into a bank,
are you saying the risk of deposit as well?
It's still risk, though. Like you're using your money as collateral for a loan. That is a risk. That's a risky move. That's what risk.
Suleiman, in short, Suleiman, to answer your question, yes, the acceptance of the credit facility saying I will take the loan at this percent for whatever purpose, that is a risk. But the money that you deposited in the bank should not have implicit risk. So they're two separate things, right?
But Bull's saying it is a risk because the sole reason that you put the money in the account is because only that bank was willing to give you credit.
We can't distinguish this by the intention of the deposit. I mean, that makes this way too complicated. Then every depositor in America would be a case by case basis, and we'd be doing surveys asking them, why'd you deposit money in this bank? I mean, that's impractical.
Yeah, right? I said your credit's at risk,
question,
not your cash.
Yeah, guys, I've got a separate question for you guys. Doesn't that show what considers how fragile the system is? Like, what if what the Fed did is not enough to quell fears? Then we have to go back. What's the other option? Is limiting withdrawals?
Yeah, and that's equally dangerous.
We're not at that point yet. They did that.
No, we're far from it.
With,
We're far. Yeah, we're far from it. Just for anyone listening. It just shows how. Please do, yeah, and more about the fractional reserve system. I'd love to know how it's changed over the years, if you know, Name.
That I can't comment on too much because I don't. I mean, I think what stock
I can make a commentary.
Let me offer one counterpoint.
We'll go after, right after redacted EYC. That would be great, please.
So just a counterpoint to, okay, yes, we put money in a bank as a depositor and we assume our money's going to be there, right, when we have it. But when you get into sort of more sophisticated, larger depositors that have, the wealthy ones that have, tens of millions or even hundreds of millions of dollars, even myself, I'm not going to talk about how much money I have, but like I've never had more than $250,000 in a single bank. And when I have put money in a bank or at a broker, I do look and take into consideration what bank I'm, putting my money at. And of course, I'm going to be more comfortable, with money at a larger institution. But, I'll just read a quote. I know this person is not, like much in the crypto community, but here's Peter Schiff's quote or tweet to sort of counter this argument that all depositors should be insured regardless.
And
so
just disclaimer, I think we've got Peter Schiff. I can't remember the date, but he will be joining the show. I'm not sure exactly when, in a few days. So make sure you keep an eye out on the show.
Good.
Yeah,
so here's what he said on March 12th. The reason for limits on deposit insurance of $250 is that larger depositors were supposed to be sophisticated enough to do due diligence when choosing a bank and suffer the consequences if they chose one that took on too much risk. So covering all deposits expands the moral hazard. So that's sort of his counter to being against having this sort of unlimited insurance, for depositors. And, I'm not worth hundreds of millions of dollars, obviously, but, you got to also look at some of these people. And I've heard numbers thrown around. Like someone said the other day, Oprah had like $600 million in this bank. I don't know if that's true, but why, just in general, even if you think that all your deposits should be covered, even though the FDIC only has a $250,000 insurance coverage, if you're that wealthy, why would you put all of your money into one bank? Even if I had, 2-3 million, I would spread it around just to take, just to diversify a little bit, just in case. Even though I don't factor in my daily life that my bank is going to collapse, I still wouldn't have all my money in one bank. So there is a little bit of risk assigned to the depositor.
Well, it also wasn't created. It wasn't created for the. It was created for the average Joe. Like they didn't create an FDIC law so a $10 million business can get bailed out, because then that would be a bailout. That would be, I'm bailing out the bank. So at that point, you might as well pay the shareholders back. They did that limit for the average everyday person, so you don't scare the mass majority of somebody when a bank run happens. Now, yes, businesses got hit
look at what
hard.
happens in bank runs.
How can that be for an average person?
But they're rich.
But how can that be for an average person?
I hear what you're saying, Bullish, but like even in a bank run, every single person that you see lined up at a bank, I guarantee you, all of their money falls under that $250,000 limit, because more sophisticated depositors with larger depositors, they're not going to be standing in line at the bank to take their money out, right?
So the average everyday Joe is safe. You know what I mean? And it's just big money.
But that 200. No, but that limit can't be for the average person, because the average person doesn't have those type of funds.
They have under 250K. Say somebody had 10 grand in there, and that's all they had. They're insured 10 grand. Say they had 20, and you know what I'm saying?
But they still have.
But if the average is only 4,000, you don't need the limit to be 250. So therefore, the limit being high as 250 is to have more coverage. And so it is.
Well, it used to be 100 grand 10 years ago. It ain't been 250 for that long. Like what, 10 years ago, it was only 100,000. I mean, that 250.
Yeah, they raised it during the financial crisis from.
There is during the crisis in the. So So what I mean is, I agree with Naim. I think there is a bit of negligence if you know that you're insured for only 250 to have significant amount of money concentrated in one bank, and so therefore, why should others be responsible for your negligence?
Yeah, see, I would love to have the problem of having $100 million and have to spread it around 10 banks. I mean, come on, you should, these larger depositors, while at the same time, I feel bad for people to lose their money because it really isn't the depositor's fault that the bank took on too much risk and collapsed, obviously. But I would love to have the problem of having, several $100 million and having to go through the trouble of spreading that around 10 banks or whatnot.
It wasn't SVB taking on too much risk. It was SVB not diversifying their portfolio and having 99% of their shit in mortgage-backed securities.
Well,
they didn't
that's the
diversify.
same thing.
That was their problem.
Yeah, they had 75% of their portfolio in mortgage-related investments with a 1.6% average weighted yield and a duration of 6 years. That's, and not proper, interest rate swaps to cover, a spike in interest rates.
Dude, if they would have had mortgage-backed securities, short-term government debt, 10-year treasury notes, I mean, they would have been fine. But like, they went all in. It's like when somebody goes all in on crypto or some dumb shit and they lose their ass. They went all in on mortgage-backed securities because when they went in on mortgage-backed securities at the time, they were good, and now they're not. So
they top ticked the market on that, and they did take too much risk, and it was bad risk management. But again, it was a bank run that took them out. So it wasn't like high loan defaults or whatnot.
No, it's not a 2008 repeat. That's for sure. It was just they didn't diversify. Should have diversified. You know what I'm saying? Like, you want to put your money in a poorly managed bank, do your research before you put your money in it. Like, before I put my money in banks, I see what is the bank leveraging. Why do you think JP Morgan, Bank of America, all these banks stay successful?
We can't expect regular people to do that, though. We can't expect regular people to.
I mean, that's money, bro. Even if it's $10,000, you should be smart about what it is.
A few $1,000 bucks.
Again, the implication that we should expect regular citizens in the American public to have not only the financial literacy, but the intention to analyze and study a bank's balance sheet before they put money in it. I mean, we're talking about depositors, not investors. It's a silly
but the average American has like $3,000 in their account, so they don't have to do that. Not many people have 250 grand or more than that.
Yeah. So anyway, bringing the point back, the bull. What based on what we've seen over the last week, what do you think is going to happen in the next few weeks in terms of the market? In terms of crypto and so on and so forth?
I mean, my personal opinion, crypto is about to run for the next few days. I mean, I called 1,800 plus. I mean, we're almost there. You bailed out a bank that had crypto attached to it, right? So that's what they say. That's why the market ran, right? So SVB was also a crypto-related bank, and then they went and shut down a crypto-related bank at the same time they bailed one out. So all that did was make the market juicy. And you got to figure, man, like, they're not going to raise interest rates this month. Powell said that yesterday on Sunday because of this bank collapse that they won't raise interest rates this month. So that's going to give
Powell the whole.
Powell did not say that.
It was in a statement from the Fed, not from Powell.
No, it was not. It was not in his statement. No, it was not. I read all this data.
Well, I got an email from Market Watch that said they weren't.
Well, Market Watch is flat out wrong. Powell, I'm going to be very clear because there was a big audience in here. Powell did not say that or even suggest that.
Yeah, and the market is pricing in.
Goldman Sachs' research team said that. So let's be very clear.
Exactly. There's brokers out there making their prediction, but the market consensus as of today is like 80% estimate of a 25 basis point rate increase. And even Bank of America just came out saying the same thing. They just came out with a statement about 20 minutes ago that they said in light of today's CPI report continues to illustrate the sticky inflation problem. Their focus is on the core services ex housing component of it that advanced 0.5% month over month. So the Bank of America is expecting a 25 basis point hike. What?
So if there is a 25 basis point hike, where will that leave us in terms of the market, in terms of the situation? Like, first of all, Is that what was it?
It won't
I mean,
do
I guess
much.
that
It
would
won't move.
It won't do anything because look at how the market's trading today. The market's pricing that in. The market's priced it in. So the Fed's not really going to do much to different than what the market is expecting. They usually don't do that unless it's a surprise rate cut, given like maybe some emergency popping up in the system, and that Silicon Valley Bank would not be that sort of a situation. So if the market's expecting 25 bips and that's the consensus right now, that's pretty much what we're going to get.
I mean, you
And
also
so-
got to factor in too, like, you know, Powell also, you know, he gave his outlook all the way to 2025 on like what he was planning on doing to get inflation back to the 2%, 3% range. So, you know, if you play the meetings and play the chart, I mean, it's not really hard to make money in the market. But like, as far as, in my personal opinion, if you want to know what will end everything, we just need a recession. You know, we need a real recession to just get rid of all of this shit. And, you know, the economy just suck ass for 3, 4, 5 months, put us in a real recession, and then you can come out on top a lot easier. But this quantum easing crap is just, it's killing everybody. That's the problem. Like, they're just, the quantum easing is the most worst thing they could do right now with the amount of money that's been printed and being at our debt cap. You know, like, there's just not enough people buying America's debt right now. So it's just crushing everything in general. You know, they just need to say,
Yeah,
hey,
you're right, Paul.
you know, like, that's what we need. We
Yeah,
need a real
I think they know that too, is like that it's going to end in a pretty decent recession, and that's the only way that they're going to be able to tackle the inflation problem. Let's just hope it doesn't get bad enough to where they just flip it on its head and start printing more money in QE. So, but yeah, unfortunately, they're going to need a recession to solve the inflation problem. Everyone, I think, knows that, and that's priced in too. And with the repricing of like the Fed, the expectation of Fed policy, the last I saw was that the market's pricing in rate cuts starting in June. I don't know if that's changed today, but yeah, so they're sort of expecting a small rate hike this month and rate cuts to start as soon as, you know, June, you know, or July, you know, August, whatever.
And so what? I mean, the bull. What's your predictions about? Do you think we'll end up getting any situation where there'll be a contagion or be any kind of situation that happens, or do you think now the situation is resolved?
With the banks, I mean, you never know, bro. Like, you don't know who's over leveraged, right? I mean, the SVB was just not diversified. You know, if Bank of America, JPM, Morgan Stanley, something like that, like, goes on a bank run, then I would be scared. But like, SVB was not this massive nationwide bank where there's 150 fucking SVBs around the world. You know, it was just a one bank that had a lot of money and a lot of Silicon Valley fintech money, right? Because they were giving out startup money to fintech companies, and that's what they were known for. And they just happened to have a decent amount of successful fintechs, you know, that blew up and were able to pay their debts back, right? So it's like, I don't think it's anything crazy. I think it's just one of those, like, they're making it a bigger deal than it is. Yeah, 209 billion is a lot of money to lose in one bank, one sector, but we got to. This is what needs to happen. We like Name just said, we need to get through the summer to where they start decreasing rates. Right when they start decreasing rates, it will open the market up for the algorithms and the market maker to have more comfortability trading more on an upward trend than in this sideways trend. Do I think we've seen the worst? I think we've seen the worst in the market, yes, last year and, like, you know, mid last year going into the end of the year. I think we've recovered from the worst. Is it going to get better soon? I don't think so. I think it's going to be a lot of sideways trading for the remainder of the year. You know, the second half of the year, I would assume recession. They have to. I would assume recession second half of the year, and then a recovery in 2024, right? So that's kind of my long-term outlook. Now, if you want to ask me about short-term, I'm a day trader. You know, my long-term is in crypto. I'm not in a stock past lunchtime every day, right? So it's long term for me. I'm bullish as hell. Now, last year, was I as bullish as I am now? No. But after everything in the market has done what it's done from last year to this year, you know, it gives history on a chart to read, right? So, like,
and they, follow the chart, not your heart. And charts look fine. They look good. I don't see like SPY tanking down to 347 where everybody thought it was going to go. I don't see ETH going back under. I don't even see ETH going back under 1380 again, right? I think we found our bottom for now, like we did before when it's bouncing off 900, 1,000 area. I think we're doing the same thing now, except up higher. But you got to play it out, dude. I mean, nothing's going to be good until interest rates are back to 2-3%. Like, that's just how it is. And until it gets there, you can increase, decrease, whatever it is you want to do with rates. But until we stop this shitty quantum easing, it's nothing is going to change. And this could drag out further if they don't do something sooner than later. So let's hope Powell does what he says he's going to do this year. And if he does, it should make our 2024 a lot better. Because I don't know if you guys know, this is like the first time in 30 some years where a fucking carton of eggs has been more than a gallon of gas. And that's where it's ridiculous to me, so it just, everybody's got a different outlook, right? That's my outlook. I'm long in crypto because I was fortunate enough to get it at the bottom again. And I'm short term in the actual stock market itself.
I just want to add one thing real quick. While the Silicon Valley Bank collapse is obviously devastating, and it's still, even though depositors are guaranteed, it's still going to affect, most of these businesses as their lines of credit have been frozen pretty much, and they're going to have to go find new funding from new banks at probably very, not as attractive terms as they got at Silicon Valley Bank. So, that part obviously is tragic. I feel bad for those people. But when we talk about the broader banking system, and Mario, I saw you tweeted out that chart yesterday from the FDIC where, the banking system as a whole is sitting on over 600 billion in, mark-to-market losses on these the treasuries and mortgage-backed securities. Well, more than half of those are not, they're being held to maturity, so they're not having to recognize those losses. I just hope, and I would assume, that the move we've seen in treasuries since Thursday, we've seen a full 1% move, like in the 2-year treasury went from over 5% to under 4% yesterday, which that was like the bailout itself to these banks. So I hope that a lot of these banks used this move since Thursday, Friday, and yesterday as an opportunity to de-risk some of their book, and take, some losses, but not as much as they had, if that makes sense. Because
cool.
It's 600 billion.
So I'm gonna jump in.
So small.
So first let me jump in, guys. I'm not sure who's speaking. Oh, it's Stock Talk, I think. No, Stock Talk, you're unmuted, bro. If you can mute, that'll be great. All right, guys. I'm gonna something we haven't done in a long time is wrap up the show. So as I wrap up the show, it's been an incredible marathon. We haven't done a marathon like this for a while. It's been a month, I think, since the Chinese balloon. We haven't done a marathon. So number one, make sure the newsletter. Number two, one of our regular guests, Matt Higgins, has a great book called Burn the Boats. Definitely check it out by Matt Higgins, which was a regular panelist. Slayman Man has been an incredible marathon. Stock Talk, Watcher Guru helping us co-host the show. It was epic. So finally, I think we can all breathe. We could all, at least take a few days off, relaxing. Good news today. Maybe you can wrap it up like final 1 minute summary, Stock Talk for everyone to a message for everyone as they go back and go about their day.
Yeah, I mean, I think my number one message would be just, make sure you're knowledgeable about these things before trying to make bold assumptions about them. Financial markets are very, very complicated. There's a lot of participants. There's a lot of roles of centralized government organizations that are deeply involved in markets. And so knowing the dynamics and when it's about the numbers versus when it's about sentiment is, I think, really important. And I think even in this conversation, a lot of the nuance got centered around the numbers when the driver was really the sentiment-based decisions and the government's attempt, at least, to protect sentiment, which, based on today's price action, seems like they did a decent job. Now, we'll see what happens over the next few meetings. Yeah, credit where it's due, exactly. But over the next few meetings, we'll see. I don't think this will change the Fed's monetary policy path significantly. I think that there's a higher chance that we don't see a 50 bips hike at the next meeting. But I think overall, the war with inflation is still here. We got a 6% print today. Sure, was that in line with expectations? Yeah, but it's a long way away from the Fed's 2% target. So I'd say keep your eyes on the prize, stay patient, don't be hyperbolic, don't be overzealous, especially when you see a couple day bounce in risk assets. It's more often an exit liquidity event than it is an actual bottom, and that's just a fact. So be careful. Wait for some real continuation in some of these trends, as opposed to jumping on and chasing the move when you have a 3-day bounce in these things. So stay sober.
It's a big one. A big one for everyone is jump off Twitter for a bit. I think you need that break. Try to enjoy your day. Touch grass. Matt, you've been with us since the early stages of this collapse, Silicon Valley Bank's collapse. Final words for the audience.
Yeah, I think this has been an incredible acquittal rather of Twitter and the value of Twitter in the town. Anybody out there who's trying to throw rocks at the community coming together, saying somehow the act of discussing and alerting everyone to the coming catastrophe if the federal government didn't step in is ridiculous. We didn't start the fire, as Billy Joel would say. SVP did by being totally concentrating in the sector, and the FDIC did by not stepping in sooner. So I think what you guys have done has been a phenomenal service that affected the debate in this country. I'm not saying it changed the debate. And we should do this again the next time there's some kind of crisis. But I just wanted to thank you. Thank you for the support of my book, To Burn the Boats. If anybody's interested, it's in the link. But thank you for doing this crazy marathon session. I think it was an incredible contribution. It was largely civil, more civil than I would have expected. I usually don't spend a lot of time on Twitter because I don't like the negativity and the partisanship rather. But you kept this largely bipartisan, largely civil, and did a great job moderating. So thank you.
No, I appreciate it. Sulaiman, I think we might have a quick final guest to come in for a bit, a surprise guest. Let me see if we're going to do it today or tomorrow. In the meantime, Sulaiman, any final words while I check with the team if there's a special guest jumping in?
Yeah, no, just thank you to everyone for joining in. It's been a long 3 or 4 days. We've had a significant amount of listeners, up to 600, maybe 700,000 in one of them. We've had important guests. We've had experts. We've had senators. We've had presidential candidates. We had Mark Cuban. So we had Matt. So we had so many great guests on here. And so yeah, I think what was very important, and I just want to let everybody know, Mario's whole thing always is make sure we keep balance. So we always try to keep balance. If there was a thought that was going one way, we always try to push against it, and just to give this entire audience a complete balance of all the different ideas and views. And I hope that by listening, you've learned a variety of perspectives, and you never thought after leaving the space, you know what, they didn't ask this question, or they didn't push back in this way, or they had an agenda, because that was something that we were trying to ensure it didn't happen, and specifically Mario.
Cool. Cameron, any final quick words for the audience? A pleasure to have you. I brought you up because I'd love to get your thoughts, and maybe any final words, give us your thoughts on the CPI data.
Sure. Well, good afternoon, everybody. I'm pleased to join you all today. So look, it was hot data, and I think that if SVB hadn't happened, the Fed certainly would have gone 50 basis points. I think that the market has no idea how to interpret this, and the way that we know this is that if you just look at the world interest rate probability function on Bloomberg WIRP pricing, I have never ever seen so much volatility in what's being priced into Fed funds futures in just 1 week. We've gone from hiking well above the Fed's target for terminal rate to now being well below it. Cuts in the second half of 2023 baked into yesterday's pricing. Now they're getting taken out of today's pricing. So we expect this to continue to be an extraordinarily volatile market, and we think that the Fed is essentially in a catch-22, which is this really tough trade-off between, do you do things to support financial stability like they did in 2016 with the oil and gas banking issues, 2018 with money market issues, 1998 with LTCM, And each of those, you saw them step in, support markets, but inflation wasn't a problem. Now inflation still is a problem, as we saw in today's data with the reacceleration, mostly in core services, ex-shelter. And that would suggest that they're in this trade-off, which means that they likely do stay engaged. And that SVB is unlikely to derail growth in a way that could meaningfully bend the the global growth story lower. I think the last thing to watch is just all of these layoff announcements are really set to hit in 2Q. So maybe we are going to see weaker employment data coming up soon. That if you look at the Meta announcement today, that was we're laying off more people, but it's not going to hit until April. So I think that we're likely going to see that build as we get into the second quarter.
And just funny enough, as we end it, there's a breaking news here from Reuters. Signature Bank former CEO being sued by shareholders for fraud. So shareholders are suing both the former CEO of Signature Bank and Signature Bank, along with three former top executives.
My favorite
What's
phrase
the reason
is
for
no
that?
one gets sued in the bull market.
Accused in New York, accused the new. So yeah, exactly. Accused of fraudulently proclaiming it was a financially strong a mere 3 days before it was seized by a state regulator. Just fascinating how every time before one of those institutions collapses, every single time, like, hey, we're good, which is ironic, and I don't know the legalities of it, but they're getting sued for that. Either way, guys, we'll be here if there's anything breaking that you can count on. If we're not here, then it's not worth it. We cover things 24/7. Appreciate it all, and see you on the next one. Hopefully not today. Bye, everyone.